Hit it.
It's Friday, March 12, 2021, episode 122. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back to the show Louis Vincent Gav, macro strategist from GavCal, where we have a terrific discussion about why the market doesn't like the U.S. policy setting, what might replace bonds as the next anti-fragile asset, and we learn why you can take the boy out of France, but you just can't take the Marxism out of the boy. Then Brent Kochuba from Spot Gamma hops on to give a great update on how the option market is setting up for this week's quad witching expiry. And more importantly, what he has seen in the single option stock universe. We get to find out, did the market makers find a way to de-weaponize Gamma? Then it's followed by a lively talking charts from my buddy, the dark arts master technician, Patrick Ceresna.
And this week in trading history, we go back to when JP Morgan lent the Bank of France some money. We then end with the segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way. So stick around. We've got a great show. Okay, Lena, hop on. What beer are we drinking this week?
So today we're drinking Refined Fool Brewing Company's Can of Beans Coffee Blonde.
Wow. Okay. I'm excited for this because coffee and beer are my two favorite things.
I don't know if they go together, but
Patrick, it's a blonde and coffee. I've made this one extra cold.
Oh, the freezer trick. I totally
Oh my God.
Trick.
This is delicious.
All right. I have a message from the brewers.
Okay.
We set out to discover the perfectly balanced ratio of beer to coffee, and the result is our wonderful coffee blonde can of beans. With a light body and big flavor, it's as smooth and lively as your favorite cup of joe. Steeped for 48 hours with a blend of El Salvadorian beans from our local coffee roaster, this is simply the best kind of cold brew.
I love it.
It tastes more like those beans that, like Franken beans.
Well, oh, stop it.
Don't do that now.
This is like something that, like, after I finish my morning coffees, I can at noon just start off with a can of beans like this to continue. I wonder if it doesn't say if it's caffeinated anywhere.
You could drink mine, Patrick.
Yeah?
Yeah.
Okay. Anyway, give us a disclaimer.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the Rocket Company rash, the Portnoy pump and dumps, and then my favorite, the sell side shits. That was Kevin and Ryan, a little bit of both. Two guys that came up with those. I love the sell side shits. It's got to be my favorite side effect so far.
All right. I like it. Okay, let's get to our first guest. So joining us now is Louis Vincent Gav, founding partner and CEO of GavCal Research. How you doing, Louis?
Hey, I'm doing great. Thanks for having me, guys. Pleasure to catch up.
Louis, it's Kev here. I've been looking forward to this for so long. I want to talk a lot of things China, but before we do, let's jump into bonds. I read recently one of your pieces, you say that the bond bear market has started. And you kind of laid out four things that you thought that might be, the signs of something would change or like symptoms or signals that you might think about getting out some blue tickets. Why don't you walk us through those, and I can tell you what they are if you've already forgotten from your writings.
Yeah, thanks. Thanks again for having me. I think whenever you do macro, there's a few questions that matter, few prices that matter more than any of them. Obviously, the 10-year U.S. bond yield is probably the one that matters the most. The U.S. dollar also matters a whole lot, and I would say the energy price also matters a whole lot. So I think there's a number of alarm bells going off on U.S. Treasuries today. The first is really, I would say, the interaction between the U.S. dollar and U.S. Treasuries. And here, I think, we're all the fruits of our own experiences. I've spent the past really 25 years of my life in emerging markets, and that obviously has had a big impact on me. And when I look at emerging markets, for me, when I see long bond yields rise, let's say I'm invested in Indonesia, and I see long bond yields rising, and I see the currency falling at the same time, for me, that sets off alarm bells. That's basically the market telling me that they don't like the policy setting, either the monetary policy or the fiscal policy or both. And today, I look at the U.S. and here we are. The U.S. long bond yield has gone from 50 basis points to 160 basis points since August. And over that period, the U.S. dollar has gone down 2 or 3%. And really, it's gone down against a backdrop where, frankly, Europe looks like it couldn't get the piss out of a boot if the instruction were written on the heels. They can't, they can't like do the vaccines. They're now blocking the AstraZeneca vaccine. It's going down against the Canadian dollar. I was checking this. You might have gotten this as well, since all of you guys are Canadian. I literally got my Canadian GP sending me an email yesterday saying, "Good news, book yourself in for the vaccine if you're over 85 years old. We can now deliver the vaccine to all the 85 years old and soon to the 80-year-olds as well." The rest of the world has been getting vaccinated for 3 months. Here in Canada, we're just starting on the 85-year-olds. So you look at all this. Frankly, the U.S. economic data has been solid. Most of the places are reopening. Texas is now going to have, for the opening of the baseball season, they're going to have like 50,000 people in the stadium. And against this backdrop, you still have rising bond yields and you still have a falling dollar. And that, to me, again, is the market telling me we don't like the policy setting. And frankly, nor shouldn't like the policy setting. The policy setting is cuckoo for Cocoa Pops. Last year, the American government added $39,000 of debt per American worker, and is going to do the same thing again this year. That's twice as much as any other country. And it's funded this through a 26% year-on-year increase in broad money supply in M2. Never have you seen such a high pace of money supply in any Western economy since World War II. Never have you seen such an increase in debt per capita in any economy anywhere in the world since World War II. And so, I think the Treasury market is starting to say, okay, hold on, where are we going here? So if I'm a foreign investor, which I am, I'm not American, and I'm looking at this and I think, well, obviously the bond market's not liking this. Obviously the US dollar is not liking this. And, my experience with emerging markets is once the market has decided they don't like something, they basically need to see either distressed valuations for them to change their mind, and we're very far from that, or they need to see a change in policy. And we're not seeing a change in policy. We're seeing a doubling down in policy. So I'll stop here because I could go on all day about this. But for me, the simple thing is, okay, the trends have started in the market. Why do we expect them to turn around? Why now that these trends have started, should they? I can understand why they might turn around for 2-3 weeks, sure, but structurally, I think the new trends are now set, and they're bearish dollar and bearish U.S. Treasuries.
So you had this great chart in one of your presentations where you talk about the increase in debt per capita, and you did in U.S. dollars over the last, I guess it's 2020. And I'll just tell you that I'm looking at the numbers here. The U.S. was almost 13,000 per person, whereas Japan was under 6.
And 39,000 per worker, per guy working.
Per worker. Oh, wow.
$39,000 per worker.
Right, and then Italy's 4, France 5, UK 7, Germany 5, Canada is actually the next highest at 8, and then China was only 1,200. So you say this policy is crazy, and you're saying that the market is starting to look at this and say, "Oh, you know what? You're running it too hot, you're too loose." And what would you, if all of a sudden I put you in charge of, let's say, either Jerome Powell or Yellen's job, what would you do? What would you suggest is the proper policy for the U.S. right here?
Okay, hold on. Let me rewind it. I'm not saying that this policy is crazy. I'm saying that the market is starting to dislike it.
Okay.
It's not my job to put a value judgment on a policy. But the American voters voted for something and they're getting it, and so be it. Our job is only to adapt to this. And the market, I think, is saying, we don't really like this policy. Otherwise, as bond yields rose, as you see bond yields rising, you'd see the U.S. dollar be a lot firmer than it's been. So my point, what I believe, what the right policy setting should be is really neither here nor there. Who cares?
Right. I like that attitude, Louis. That's like too many people sit there and try to say it. I tried to trick you into actually giving me your opinion. Okay, so let's talk about this. You're absolutely right that it doesn't really matter what you or I think is the correct setting. It's actually more important of where markets are headed. So the U.S. is running this hugely loose fiscal and monetary policy. How do you think it plays out? Does this then cause a crisis in the bond market, in the currency market, or is it just one of these things that'll grind lower, both of them, and then eventually we'll hit a point where that's enough, and the trend will reverse? How do you see it playing out?
Well, look, one of my favorite economists was a French economist called Jacques Rueff, and he had this phrase that I think is great, where he says, "Inflation is funding expenditures that give no return with money that does not exist." Um, and if that doesn't describe the current situation, I don't know what is. Because when you look at this $13,000 increase in debt per living American, that's basically from the baby that was born today to the guy who's 100 years old and about to tragically die from COVID. Whether the whole gambit, they each have an additional $13,000 of debt on their head, and the big question is, what did this debt finance? What did this fund? Is there a new Hoover Dam? Are there new airports? What productive investments were put in place that would allow the repayment of this debt? And the answer, excuse my French, but is absolutely bugger all. The money has just gone to fund straight up consumption and, to a large extent, financial speculation. You have not had an increase in productive investments whatsoever. I think the last major new airport in the United States was Denver in 1991. To the point where you can question whether the U.S. even has the ability to build new airports. And so, I look at today, I see this massive increase in debt, and, I'm not against debt. If you increase debt and you fund productive things with that debt, so much the better. Then you can repay the debt down the road. You have more growth. Everybody's happy. I think there's a sort of, in our business, very often there's a sort of Calvinist attitude to debt, right? It's like, oh, debt is, that's where the devil lives. And increase in debt are bad, etc. No, increase in debt can be terrific if they go into productive investments. But the reality today is that this is absolutely not happening, and in fact, they're doubling down on it. Right? They're going further and further down. So, going back to Jacques Rueff also used to say that the exchange rate is the gutter in which unearned rights accumulate. That basically, the more often than not, what happens is, as you print a lot of money to do unproductive things, it's usually the exchange rate that takes the brunt of the adjustment. And so today, now I believe we've started a US dollar bear market, and that this bear market will continue for a very long time.
And do you think that the bond market will actually as well eventually have, a spasm, a fit, or is that something you feel that because the Fed can go and influence that's most likely going to be continued to be under control, so to speak?
Well, look, do I think, Davin, we just had a fit to some extent? I mean, bond yields have just more than doubled. We've gone from 50 basis points to 160 basis points. It's not been a great time being a bondholder, basically over the past 12 months. And on this, this is the second reason I'm bearish bonds. The main reason people own bonds is because it's the anti-fragile asset in their portfolio, right? It's the asset that you turn to in times of trouble. When things go badly, you hope that your bonds do well for you. Okay. I think I sent you a piece on this, but I look a lot at portfolio construction a little bit like I would building a rugby team. Now, I don't know if you've ever played rugby or watched a rugby game, but rugby is an interesting sport because you have guys of all shapes and sizes. You have like tall, very tall, lanky guys. You have short, fat guys. You have fast guys. You have all shapes and sizes because there's lots of different jobs to do on a rugby pitch, and so you need different body sizes. Well, the same is true in a portfolio. You need different shapes, different body sizes. And so for me, the bonds were the props, or in American football, they'd be the offensive linemen. They're the guys that basically hold things together for you. Except that, the bonds for me, when you move from 1.5% real on your bond valuation to minus 2% real on your bond valuation, which is where we are today, then your bond basically is like an offensive lineman that's gone from weighing 350 pounds to weighing 140 pounds. Now, who needs a 140-pound offensive lineman? Or who needs a 140-pound prop? The answer is, of course, nobody. And so when you look today at 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 bonds, what's very important, I think, is that over the past year, you've really had three different periods of equity weakness. You had the second half in March, where basically the markets froze, right? The markets completely froze. Initially, bonds rallied, and then they sold off. If you look at the last 2 weeks of March, bonds sold off along with equities. Then you look at the basically late August, September, October period when equities sold off, bonds also sold off. And then you look at the past few weeks. I know we've just rallied in the past week, but up until a week ago, you had another period of sort of equity markets starting to feel wobbly. The Nasdaq was down 10 or 12% from its most recent high at one point, and during that period, bonds also fell. So we've now had in the past year 3 separate periods where you lost money on equities, and while you were losing money on equities, you were also losing money on bonds. To the point where you're like, well, hold on. The main reason I own these bonds is that when I'm getting beat up on the equity markets, they come and they save my bacon. But if they don't even do that, what's the point of having them? Like,
Right.
if you look at your portfolio and what you have is just an asset that continues to slowly grind lower. And even when there's increases in equity volatility, even when equity markets sell off, they continue to grind lower. You're like, oh, the hell with you. I don't need you in my portfolio anymore. And that to me is the big Damocles sword hanging over bonds' heads, is that, for the past 40 years, they've become the world's ultimate anti-fragile asset. It's the thing that everybody owns to protect against downsides. But now in my career, I've seen this time and again where an asset is repriced and perceived as the ultimate anti-fragile asset. When I moved to Asia in '97, it was on the belief that whatever happens in the world, Asia, you'll have Asian growth. And then in 2000, it was, well, whatever happens in the world, we need technology. In 2007, U.S. real estate was the ultimate anti-fragile asset, right? It was like, oh, well, if there's a slowdown, then interest rates go down, and that's bad for real estate. And if there's growth, that's good for real estate. So real estate is just awesome. So you can't own enough U.S. real estate. And today, the perception is bonds are the ultimate anti-fragile asset class. Now, the reality in my career is each time something has been perceived as the ultimate anti-fragile asset class, and you had also energy in 2011, 2012, right? It was, oh, well, there's not, the end demand for energy will always outpace its supply. So you can't go wrong being long in energy. Seen this time and time again. And when an asset stops being perceived as anti-fragile, it's a very painful fall. As Arthur Miller wrote in The Crucible, an hour before the devil fell from heaven, God thought him beautiful in heaven. And
You're
and
so
that's where I
literary,
think,
Louis. You're making me feel like I don't read enough. So listen, I completely agree with you. I always used to laugh because I remember watching this value manager on, and he's giving us all these value picks, and they're going through and he's giving you all these crappy down and out stocks, and they're great. Like if your value they're cheap assets, and then at the end they ask him is there anything else that you would recommend, and he says and this is like a deep value guy, and he says the last arbitrage out there is the fact that bonds, long-dated U.S. Treasuries, are negatively correlated to stocks. So you basically want to have a ton of them in your portfolio as a hedge. And I thought, geez, you know what? When the actual value guys are buying long-dated, U.S. Treasuries as a hedge, this is getting late.
I'd go one step further on this, Kev. I've had it argued to me in many conversations with clients where people tell me, look, bonds are unique because they're the one asset class that doesn't suffer from the supply-demand equation. Anything else, you increase the supply, logically the price should go down, right?
Right.
If I increase the supply of, let's say, Microsoft shares by 3 or 4 times over the next decade, that's going to weigh the share price of Microsoft.
Right.
But not bonds, because bonds, the more bonds you issue, then the more the increase in government spending, and the more the increase in government spending, then the lower the economic growth, and the lower the economic growth, the higher the returns on bonds. So actually, the more bonds you issue, the higher the returns on bonds. The only thing is, I find it so sad that it took us 20 centuries to come to this. If we'd only discovered that, centuries ago, things could have been so much greater.
So I actually have a question in terms of you're mentioning the clients are pushing back. I'd love to get your sense about where we are in the realization that bonds are no longer the anti-fragile asset that we were led to believe in terms of the long-term serious money. Like, where are they in shifting their portfolio? Like, are they not even starting or just starting to think and listen to you, or they've already kind of seen the handwriting on the wall and are starting to sell? I would love to get your impression about where we are in the longer term cycle of big long-term money.
All right, so I'm going to make like a Jesuit priest and answer your question with another question. The my starting point, as I said, is that the macro environment is driven by oil prices, U.S. dollar, bond yields. Now, up until roughly 6 months ago, all three of these bond yields were going down, oil was going down, U.S. dollar was going up. In the past 6 months, the macro environment has been completely turned on its head, right? It's been completely turned. Oil prices are now going up and just continue grinding higher every single day. U.S. bond yields continue to go up and basically take out everybody's like, oh yeah, there's a technical ceiling at 120, and you cut through that like knife through butter. Oh, there's a technical ceiling at 140, cut like through that like a knife through butter. Again, 150. So bond yields are creeping higher, and the U.S. dollar is basically grinding down. Even on bad news for Europe, even on bad news in Canada, the U.S. dollar doesn't manage to rally. So, the investment environment has changed, no doubt about it. It's changed dramatically in the past 6 months. And that comes back to my question to you is, so if we assume that really the change started 6 months ago, that it's basically becoming visible now. As you basically break through 150, I think that was a key level. As oil breaks through meaningfully through $60, I think that was a key level. Now people can't say, they can't brush it off anymore. Do you really think people have adjusted their portfolios? I highly doubt it. I think they're really just waking up to the fact that the macro environment is changing. And so the change in portfolios is going to be the story for the next 2 to 3 years. These big pension funds, these big insurance companies, et cetera, they're very slow moving beasts. You got to go through investment committees. You have to, if all of a sudden you decide, you know what, I should have an energy exposure, you got to find an investor to do that for you. So no, I don't think any of the big players have adjusted their portfolios whatsoever. Nowhere near. It's just starting. But do you think differently?
No, I completely agree. I was just wondering if, I don't talk to those big investors as much as you do, and I was just wondering if you saw them, maybe they were further along than I guessed. But to me, it feels like the attitude, they're still talking about, yield curve control. They're still hoping that this is going to be transitory, and people don't believe in inflation. Actually, why don't we talk a little bit about the last couple of weeks where we did see this, real problems in the bond market. We saw the 5-year especially get hit. I looked at it, and to me, it feels like that your story about growth in America just was starting to get realized, and we got pulling forward of the vaccine, and just basically the reopening just came forward, and that's why the bond market, stumbled so badly. Do you see it any differently, or do you have any color to add?
No, I think that's part of it. Look, when you look at the sell-off in the bonds, you can look at it and say, all right, U.S. Treasuries are selling off because option one, the U.S. economy is going to reopen and it's going to be rip-roaring and everything is awesome. And the U.S. is doing much better on the vaccine than most other countries, so it's going to bounce back stronger, etc. Sure, yeah, I buy that. But then my question is, why isn't the U.S. dollar rallying on the back of this, right? If the U.S. economy is going to reopen before everybody else, and the economy is going to rip roar, then you'd think all the foreigners like me would be piling their cash into the U.S. So I want a piece of this. Let me buy some Macau casinos, or let me buy some New York real estate. Vegas casinos. Let me buy some New York real estate or something. Option two, the market is looking at the not only the supply coming out right now of out of the Fed, out of the U.S. Treasury, excuse me, the supply coming out of the U.S. Treasury, not only the one that's just come out, but the one that promises to come out over the coming year, and realizing that the numbers are now so large that the only possible buyer of all these bonds that are coming in is the Federal Reserve itself. And you're already seeing that. The Fed has basically told us, look, I'm going to do QE of about 120 billion a month. Well, last month was 180 billion. Now you think, okay, here we are in an economy with GameStop, with Tesla, with Bitcoin, with SPACs, with signs of bubbles everywhere. And I love your analogy, by the way, Kevin, of the rolling bubbles. But if you're a central banker, this is the time when you start to think, okay, maybe time for me to take the punch bowl away, right?
Right.
You look at this and you think, okay, yeah, this party, you look at GameStop and you're like, yeah, this party is hopping. It's like they've got
They're hanging from the chandeliers. They're hanging from the
got
chandeliers.
the volume on at 11 here.
Yeah.
And so the party's hopping. If you're the Fed, this is when you're like, okay, let's tie this in. And instead, they're literally going to the speakers and say, yeah, these go to 11. Crank it up. Instead of doing 120 billion of QE, let's do 180 billion. Now, why on earth would they do that? And by the way, even as I move from 120 to 180, the 5-year still sells off. The 10-year still sells off. Imagine if I hadn't gone from 120 to 180, where would bond yields be now, right? So I think there's two ways to look at this sell-off in bond yields. Is either it's because the U.S. economy is going to rip roar, or it's because the market is starting to worry a little bit about the supply that's coming in. And to me, the answer to is going to be provided by the dollar. If it's all about the economy, U.S. economy rip-roaring, I'd expect the U.S. dollar to do well. If it's all about this, basically the Fed being cornered and never being able to not add 180 billion a month, then you'd expect the U.S. dollar to sell off. And right now, it's more the latter.
Okay, so given that scenario, how do you see the equity portion of the kind of equation working out?
Well, the first thing is, look, I have, everybody's got their own biases, right? And that reflect their own experiences. My bias is I like to buy things that aren't too expensive and undervalued currencies. And, I know intrinsically that when the US dollar goes down, the rest of the world tends to outperform, and especially emerging markets, which is where I focused, most of my life. And whenever the US dollar goes down, usually not only do emerging markets do well, but the shittier the emerging market, the better it does.
Okay.
Because the main sort of break on growth, if you're a really shitty emerging market, is access to US dollars, right? And the big problem when you have a strong US dollar is you're rich guy in Indonesia, or you're rich guy in Thailand, will look at the strengthening US dollar and say, well, I don't want to deploy my capital at home because it's getting eaten away by the falling currency. So I'm just going to buy US treasuries, or I'm going to buy Microsoft or a condo in Miami or whatever else. If you have a falling US dollar, meanwhile, it's completely different. And all these guys bring their money back home. Okay. So today, I think the first thing you want to do is, if like me, you believe the US dollar is now into the structural bear market, is you look for the shittiest emerging markets.
Okay, so you're saying don't even worry about the U.S. equities because there's better things to own.
Exactly.
Okay, so now listen, I actually meant to ask you this, and I'm just going to rewind a little bit to the bond market. And then you mentioned that you focus on portfolio construction, and we've kind of agreed that the bond market is no longer becoming, or the bonds are no longer becoming that anti-fragile asset. Why don't you talk a little bit about how you would restructure portfolios given these kind of changing dynamics? What is somebody that was traditionally, had, let's say, 30 or 40% bonds? What should they be looking, and what are some ideas for them to look at doing?
Well, look, obviously, I'm going to preach for my parish there, so people may decide that I'm just being a sales guy and discount what I say. So I'm disclosing it because we manage today roughly 2 billion in $2 billion in Chinese bonds, and to me the Chinese bond market. I've argued for the past 10 years since China started to internationalize the renminbi that the Chinese bond market would be the new anti-fragile asset class. And, since then, Chinese bonds have outperformed all other bond markets. The renminbi, you and I have discussed this before, but it's the strongest currency in the world on a 1 year basis, on a 3 year basis, on a 5 year basis, on a 10 year basis. For the very simple reason is compounding matters.
Right.
And interest rate differentials matter. Einstein jokingly once said, there is no more powerful force in the universe than compounding interest rates. And I fundamentally believe that actually to be true. And so today, you look at China where you make 1% real on 10-year bonds, and you look at US 10-year treasuries where you make minus 2% real. That's a 3% difference. So if you compound that 3% difference for 10 years, you basically, you get 35% more difference. It means that for you to lose money on Chinese bonds vis-a-vis US bonds, you need the renminbi to fall by a third against the US dollar, which hasn't happened since 1995, and which I struggle to see how you're going to have the renminbi fall by a third when China today is running a trade surplus of $70 billion a month, and where bond inflows are really running at roughly $200 billion a year right now. You have so much money coming in because of the interest rate differential that you look at this and you think, okay, this, between the inflows, the trade surplus, the massive differences in monetary and fiscal policy between China and the US, the obvious slam dunk today is to own not only Chinese government bonds, but I would say Pan-Asian government bonds, because China is basically doing to Asia what the Deutschmark and Germany did to Europe in the 70s and 80s. As China becomes Asia's trade and reserve currency, then everybody's bond yields around the region start basically aggregating or converging, towards the Chinese bond yield. So with Europe as a parallel, when Europe stopped being dependent on the dollar and instead moved gradually towards the Deutschmark, where you actually made the most money was in Italian government bonds. You made great money on German bonds, but you actually made more on Italian government bonds, and you made more money even on Greek bonds until they went bust. Well, today, if we use that parallel, China and the renminbi is rapidly growing as Asia's trade and reserve currency, which is great news for Chinese government bonds, but it's possibly even better news for Indonesian government bonds or for Indian government bonds, where bond yields might go from 7 down to 3. And while the currency goes up, and if that happens, you make money like a bandit.
So, Louis, there's so much there to unpack. I'd like to
Sorry.
just start. No, listen, it's awesome. It's awesome, and I love it because it's something that's very much against the conventional narrative. You get onto FinTwit or all these places, and everyone's screaming about, how the Chinese currency is going to collapse and how it's been a terrible performer.
How long have they been saying that?
Oh,
and how's that worked out for them?
And I was shocked because I didn't understand until I saw your charts the power of compounding. And Alex Gurevich is a longtime bond bull, and he always used to say, all these people that are just looking at the bond price, they're doing it wrong. They need to look at the total return charts.
Of course.
It's the exact same thing with the currencies, and especially in a situation where you have a currency that is earning so much of a bigger yield. And when you sent me those charts of the renminbi, and I was like, holy smokes, it just blew my mind. I was like, this is unbelievable. And it's just been a great trade in terms of owning these things. I actually like to give you kudos. The last time you were on our show, we were talking about Hong Kong, and you were saying, listen, there's a lot of I would say, angst in the market about the turnover and stuff. This isn't going to end up being bad in terms of they're going to figure out a way around this because it's in their interest to figure it out. And I find your voice of reason on these trades just so refreshing. And not only that, I'm like in this to try to make money. And if I think that this is going to make money, which I've seen it's making money, and the fact that everyone's telling me the other thing almost attracts me more to it. But why don't we talk?
I'll interrupt you.
Yeah.
Sorry to Kevin.
No.
Thanks a lot for the very kind words, and I'm sort of blushing over here. But I'll just make one point: is that the Chinese government bond trade has been making great money and continues to make good money. The U.S. Treasury trade has made great money for years and is no longer making money. And given the yields, whether the real yields, given the policy settings, given everything, U.S. Treasuries, European government bonds, they're not going to make money for years. It's just not. It's just mathematically, it becomes really hard. When you start off with a negative real rate of -2% and budget deficits that are growing by $1 trillion every year, it's just very hard to make money
Right.
with those trades. And so what's happening right now is, to your point, yes, the Chinese government bond trade has made great money in the past 10 years, in the past 5 years, in the past 3 years, in the past year. It's outperformed basically all the other bond markets that you care to pick on any kind of time frame. But before, it didn't really matter. It didn't really matter because, you know what? If I'm invested in U.S. Treasuries and I'm making 8 or 9% a year with my U.S. Treasuries, I'm like, oh yeah, China makes 10. Yeah, good for them. Yippee. What do I care? I get my 8 or 9 and that's all I need. And I'm a US pension fund and that's awesome because I get my 8 or 9 and that's what I need. But in essence, when your bond yields move from 5 down to 0, what you've eaten is you've eaten the capital gains of the future, right? Now, if I invest in a bond, it's not going to have any more capital gains. It's not going to have, it doesn't have any more yield. It doesn't have any more capital gains. Meanwhile, China continues to chug along and give you that 5, 6, 7% a year. And so now you think, shit, before, if you're a pension fund, you need to make that 5 or 6%. And now you can't make it in US Treasuries. And the one place you can make it is Chinese government bonds. And so money is now really starting to pour in. For us, so we manage money in Chinese fixed income. When COVID started, I thought, oh well, we're going to get a bunch of outflows. Lo and behold, we've had more inflows in the past year than any other time, simply because there's this need for yield around the world. And the point I want to make, and I'm being very long-winded about it, is that this is only just starting. People are only just now waking up because now they're losing money on their bonds. They're only now waking up to, oh, my bond portfolio is not doing the job I need it to do. What are my choices? Oh, boom, this one over there. All right, let's do that then. And you are now starting to see these flows, but it's just starting, and it's going to accelerate from here.
Okay, so let's talk about if we do see those flows, what are the risks? Let's just stop and why don't you give me your first of all, impression of how things might have changed with the Biden administration, and are you worried about their stance towards China?
Yeah, that's the big risk. Now I think initially what you see is continued rise in the renminbi and continued fall in the U.S. dollar. Now, initially, I would say the first 10% makes the U.S. happy. Currency's going down. What's not to like? That means all of a sudden, Michigan and Pennsylvania and Ohio and all the swing states, they get more industrial jobs. Everybody's happy. Biden, who likes to portray himself as Scranton Joe Biden and man of the trade unions and all that stuff, he's not going to be upset that the U.S. dollar goes down. I think the first year of this, as the U.S. dollar goes down, the renminbi goes up, everybody's happy. Markets are happy. Everything goes well. The problem becomes, of course, that in a world where oil prices are going up, in a world where lumber prices are going up, in a world where metal prices are going up, in a world where food prices are going up, in a world where the inventory of homes in the U.S. is at a 50-year low, where the inventory of secondhand cars is at a 30-year low, where the supply chain disruptions are everywhere, where inventories are running low. As the renminbi starts to go up, all of a sudden, does that become the straw that breaks the inflation camel's back? Where all of a sudden, everything that you're importing from China now starts to, your stuff at Walmart and Costco and wherever else starts to bite. And so, that's when all of a sudden the policies start, the policymakers, um, then they're stuck, right? They can't raise interest rates because there's too much debt to crush the inflation, but the inflation is appearing nonetheless. So how do you deal with it? Well, I think you deal with it through price control measures, which is what governments always start off with. It's like, oh well, let's put in rent controls. Let's put in, taxis aren't allowed to raise their fares, or this or that. And before you know it, you've made your economy much more inefficient with all these price controls. And as you make your economy more inefficient, your currency falls more, and you get into a very bad cycle. But again, we're not there. The first wave is, the next year, renminbi goes up, U.S. dollar goes down. Everybody's happy about it, and initially the U.S. thinks this is fine.
Okay, so then the real danger occurs when, ironically, they get a little, that old saying, "Be careful what you ask for; you might get it good and hard." And
Exactly.
you actually get
Or another way, I'm sure you've had this experience a few times in your life. Is you never know when you've had enough until you've had too much.
right.
Uh,
And so you would argue that actually could be inflationary eventually. A Chinese currency strength could sow the seeds of kind of.
well, let me turn the question around to you once again and say, look, what's deflationary today? Where's the deflation going to come from? In the world that we live in, where is the deflation going to come from? Is it so? We see all the raw materials going up, right?
Yeah.
We see the supply chain disruptions everywhere. Semiconductor prices going through the roof. Ford announcing that there's going to be a shortfall of 650,000 F-150s, the most sold car in North America, because of lack of semiconductors, so on and so forth. Wherever you care to look, you just get inflationary signals. Okay, so where is the deflation going to come from? Well, you could say the deflation is going to come from asset prices. As long bond yields creep up, asset prices are going to tank. But central bankers are pretty much clearly telling us we're not going to let that happen. We're going to print and make sure that asset prices don't fall. That's the ECB just came out and said it again 2 days ago, right? It's like, oh, bond yields in Germany go from minus 60 basis points to minus 20. God forbid, let's intervene and make sure that bond prices don't go down. So you could say, well, they're going to come from falling labor costs. And deflation is going to come from falling labor costs. Well, how do you do that when you're paying people to stay at home? When basically, by and large, in most countries, we're rapidly moving towards some kind of universal basic income. How do you, and politically speaking, it's become unacceptable to have falling labor costs, right?
Right.
I mean, it's if you end up with falling labor costs, you're going to have riots on the streets. You already have riots on the streets, for that matter. But which is actually an interesting other side point on the divergence between China and the rest of the world is, for the past 10 years, I've had clients tell me, but aren't you worried about riots on the streets in China and revolutions? Meanwhile, often I'd be asked this while, in offices in Paris, while, you could smell the tear gas from the weekend's riots unfolding in Paris every weekend. So then the third, so I don't think it's going to come from falling labor costs. Everything is being done to raise labor costs, rising minimum wages, etc. So then you come to the last possibility, which is we're going to have deflation through tremendous productivity gains. But how are we going to have tremendous productivity gains when capital spending is so weak, when all the government spending isn't going into productive endeavors, but into paying people to watch Netflix? How is that going to boost our productivity?
Yeah.
So I look at it, I can see where the inflation is coming from. For the life of me, I can't see where the deflation is going to come from.
Well, I guess implicit in your belief is the idea that COVID has ushered in a new change in attitude about politics, meaning that we will no longer accept the fiscal hawks and we will no longer accept the Tea Party sequestration.
I mean, okay, isn't that fairly obvious?
Yeah,
I mean,
no, I
you're
agree
right.
with you. I'm just saying that I think that is what the deflationists will say. They will
You're
argue.
right.
They will argue that on the other side of this, once we get through COVID, we're going to go back to balancing the books. We're going to do this, and we're going to basically
And you know
take a
what?
page
You know
out
what?
of Europe's book.
If we get to that, I'll change my mind again.
Well, that
you know?
no, I'm the same way. That's what I always say. I always say until they show me that they're going to actually go and become deflationists. I mean, deficit hawks. I'm going to assume that this is the new normal and that they're going to continue to spend. And so I
Absolutely. I mean, and I think to believe that we're getting back to some form of Tea Party, uh, when every politician from the left and the right today is making noises in the opposite direction, to me, looks like a second wedding. It's the triumph of hope over experience. Uh, it's it's just like, what do you base this belief on? It's just
That made me laugh, but that's a good line. I like it. You got so many great lines. Okay, so let's see. So you mentioned Europe. I got to go there. I think we're going to agree on a lot of things. They do seem to be having trouble figuring out how to steer in this new post-COVID environment. Why don't you tell me what you think they're doing and what it means for asset prices in Europe?
To be honest, if you're looking for a deflationist outcome, I think you have to look to Europe. Europe has been sort of a deflationary black hole. For the first part of my career, Japan was the deflationary black hole of the world, right? And for the second part of my career, or really the past 10 years, since the European crisis of 2011, Europe has been the deflationary black hole. And you could say, well, if you want to make a deflationary scenario, the scenario would be pretty simple. It'd be, well, look, springtime in Europe is rioting season. It's when it's when you put on your rioting gear and you go throw stones at the police. And we seem perhaps very well set up for a very good rioting season this season. Young people really upset to have been stuck at home for a year. Governments that are proving really ineffective at basically negotiating vaccines or anything like that, and their only thing they can manage to do is locking people at home. Again, you saw Italy yesterday announce that they're reconfining. Even though, funnily enough, I was looking through the Italian data this morning on the back of this. Zero increase in hospitalization and zero increase in deaths. So you're like, what the hell is going on here?
Right.
So politically, I think the level of anger is, it's high. It's very high. So you could say, okay, come this spring, you have riots across Europe, and at some point you need to have an election either in Italy or France, and maybe you get an electoral outcome in either Italy or France, where basically either Le Pen or Salvini comes in and blows the euro up.
Okay, so what does that look like, and how does that play out?
Well, I'm not saying it's going to happen.
No, I know you're not saying that.
I
I know you're not saying that. You're just saying that this is a possibility, and I like to get ready for thinking about different possibilities. And what would that look like, and how would you envision that playing out?
Well, I would say the more likely, I grew up in France, so you can take the boy out of France, but you can't take the Marxism out of the boy. Having gone through the French educational system, and so I tend to believe that the elites in any given country will formulate policies that benefit said elites. And so if you look at different countries, who the elites are, in France, the elites are your civil servants who went to l'ENA, who are very bright, and they did all the right schooling and they ticked all the boxes. And their ultimate goal in life is to get a job in Brussels, because then you don't have to answer to voters, which are who wants to go wake up at 5 a.m. to go shake the fireman's hand, right? It's being a politician is a crap job. But if you're in Europe, first you make important decisions, and secondly, you don't have to answer to voters, and even better yet, while you're there, you're on a special status, so you don't pay taxes. So it's like it's a pretty good deal.
Sweet gig.
It's a sweet gig. The one downside is you have to live in Brussels.
The mayonnaise on the French fries doesn't make up for it.
No. Well, yeah. For me, it's I would gain another 10 or 20 pounds probably. And the beer is good.
Yeah.
The beer is very good. So that'd be yeah. I need a whole new wardrobe every 6 months. So yeah, that's the elite in France. The elite in Spain is basically all the big aristocrats who own like 80% of Spanish lands and who make so much money from the EU farm subsidies that no way will they want to break from Spain. The elite in
Ah,
Germany are all the industrials, right? The Mittelstadt, the small, and they've benefited massively from the euro because the euro has basically meant that the French and the Italians can't devalue anymore.
right.
So they've wiped the floor with the French and Italian industry, and they've taken over all of European industry. The one the one sort of weak link in this whole chain of people who are all massively pro euro are the Italians, because in Italy the elite also happens to be these industrialists, and they're the ones who've been absolutely massacred by the euro. They're the ones who've been butchered because they're the ones who've lost all their business to
Germany.
Germany,
Yeah.
and for them it's for a lot of them, France is a super centralized country. Everything happens in Paris. Italy, like Germany, is actually quite decentralized. Um, and so for them, for a lot of these industrialists, it's not just about money. If you're the industrialist and you live in a town of 20,000 people, you basically hire that entire town. And when you have to fire people, it's you're firing people who maybe have worked for you for 3 generations. It's extremely challenging. And so with this in mind, the one part of Europe where there is anti-Euro sentiment amongst the elite, it is Italy. So it's a very long-winded answer to your question. If you expect somewhere to break, I would say look at Italy. Draghi's in there now. If basically, he's going to have a short honeymoon now that he's reconfined people. If in 6 months' time his government falls, you'll have basically spent the Draghi card, which was your sort of, your ace in the hole for things. If things went badly, you always had Draghi you could play. Now you've played that card. You can't play it anymore. If Draghi fails in the next 6 months, then you have an election. Salvini comes in, and then what? Then it's not obvious that Italy stays in the euro. Italy could say, you know what? We're out of the euro. We devalue by 50%, and we'll pay back Germany, France, and everybody else in Italian liras. Thank you very much. Which case, every German pension fund and insurance company is basically bust and has to be nationalized by the um, by the by the German government. So in this scenario, where does the euro go? Uh, the euro goes back to 80 cents. It's uh, it's a massively deflationary shock for the world. And then you and I can come in and buy beautiful apartments in Paris for cents on the dollar.
Forever a trader. Okay, I have two more countries. We've been going all around the world. I have two more countries I want to ask you about. Let's start with Japan. What are your thoughts there?
I'm a raging bull on Japan.
Okay.
I'm a raging bull on Japan. Japan's an interesting one because Japan's been in a terrific stealth bull market that really nobody's talking about.
I 100% agree. Yeah.
It's actually interesting. If my dad wrote a number of pieces on this, but if you look at the Japanese stock market, X financials, and there's the Daiwa X financials index. So you just assume, okay, Japan's got zero interest rates and will have zero interest rates forever, so I don't want to own the banks, right? It's just like I might want to own them for a trade of a week, but who wants to own that for 5 years? The banks in Japan, every time they walk in, turn the lights on, they lose money. So okay, I don't want to own that business. But so you strip that out of the index. The rest of the benchmark, man, it's the best looking chart out there. It just is. It's like the market is just it's like a 45-degree angle. It looks like Madoff's returns. Uh, hopefully without the end result.
All right.
And I don't believe it will be that end result because these other businesses, you have a ton of super interesting businesses in Japan. Here's an interesting one actually. If you think of the businesses of the future, you list where are the businesses of the future and who today are the leaders. Let's start with fintech. I would argue that today China is a leader in fintech. Um, if you look at artificial intelligence, either the US or China, and it could very well be China. If you look at robotics, it's undeniably Japan. Japan's a generation ahead of everybody else. Um, if you look at the auto industry, well, Toyota owns roughly half of the auto patents out there. Um, and I would say, the auto industry, I still think Japan is actually a world leader. If you look, um, if I asked you, so, if you go through that list, is the U.S. is actually not a leader in as many fields as you would expect. If you look at semiconductors, the leader is now Taiwan, and this by a long shot, followed closely by South Korea. Um, if so, yeah, online advertising, U.S. is by far the leader. But is that such a key
Right.
industry for the future?
Okay. So you got
not sure.
Japan. I'm going to give you one last one here before we let you go. India.
So India is an interesting one. It's an interesting one because it looked like the world, a year and a half ago, 2 years ago, it looked like the world was starting to split. The technology world was starting to split into, in essence, two blocks: a developed market block led by the U.S. and U.S. companies, and an emerging market block led by China with Alibaba, Tencent, etc. And today, if you go to Malaysia, if you go to Indonesia, etc., it's increasingly Alibaba, Tencent, and all these companies. India, meanwhile, in the past 2-3 years, has turned around and, in essence, kicked the U.S. companies out, kicked the Chinese companies out, which they can do because of the size of the domestic market, and has decided we're going to have our own national champions when it comes to technology stuff. And so, maybe they'll succeed, maybe they'll fail. But I look at India, and I think what they're doing is actually decently exciting, because it's the one last major market out there that's, for all intents and purposes, both non really fundamentally penetrated and at the same time non-fragmented. So the potentials for economies of scale in India in rollouts of businesses are just enormous. So I think it's an exciting market for sure. I think it's one that you can't really ignore.
Okay. So now, Louis, before you go, let's talk some skiing. So
Sure.
you grew up. Now, did you grow up in Paris? Like, I can't remember.
Yeah, I grew up skiing in the Alps.
Oh, you did
Yep.
though. So you went up into the Alps. Okay. So now
Yeah.
you've. So for those who don't know, Louis is a transplanted Canadian. He lives. He has a tough life. He lives near Whistler all the time. So he's skiing there, but he got to go into what you went off into the interior BC and did a little skiing.
Yeah. I try to hit Revi at least once a year.
Okay, but you also went off piste and did a little bit of that. What?
I did.
So first of all, were your conditions good? Did you get some nice
It was epic. It was. I mean, this year, I really shouldn't do this. I really should say how terrible it's been, and how what a miserable time we're having, etc. And how I should do this because first, for all the BC businesses, of course, COVID. All the BC tourism and skiing businesses, it's been a disaster.
Right.
And then, of course, for all the the foreigners who love usually skiing BC because it's one of the best places in the world to ski, they couldn't come. So I really should say it's been terrible and you didn't miss anything, etc. But I'm not. I'm going to say it was just awesome,
Yeah.
and it was all the more awesome since you're the only one skiing it. There's nobody else.
There's
here.
nobody out there. So what is it like versus the Alps? Like, I'll tell you a story. I go cat skiing, and I remember one time we were on a cat skiing, and then we were there, and there was this German old guide that we had, and we were asking him, we was like, "What's it like in the Alps? We should go there." And he looked at us and he says, "Why you guys are idiots? You guys have the best snow in the world here, and why are you thinking about going to the Alps?" Was he right?
So I think that. Yeah, I think look, the Alps are awesome, and a good day in the Alps is absolutely awesome. But the snow is undeniably more fickle. So it's. But if you happen to have when there's just been a big snowfall, then it's awesome. But it definitely doesn't get as much snow as BC. So that's number one.
Right.
Number two, BC snow is heavier. It is Pacific Coast concrete, right? It's heavier, but that has an advantage, which is that you can ski much steeper stuff.
Ah, okay.
If you're into skiing, fairly steep stuff. The problem is the Alps, the snow being much lighter, it sort of it doesn't stick, right? It just sort of falls underneath you.
Okay.
Then the third big challenge in the Alps is, if you want to go and get good snow, you're forced to go pretty high. And if you want to get powder snow, you're in essence forced to, hike up to glaciers, backcountry ski to glaciers, etc. But when you ski glaciers, you always have the risk of crevices, right?
Okay.
And of falling crevices. And, some of these crevices are so deep that people fall in them and then they're never found
Oh,
ever again.
it's a shitty way to go.
So far. It's not, it's definitely, I'd rather not go at all. But if I have to go, I definitely don't want to go that way. Like, dying of cold at the bottom of a crevice over many days now. So that's the beauty of Canadian skiing, of course, is, you don't have to ski that high. You don't have to ski on glaciers. And so it comes with a lot less risk on that front. The risk, as you know, in Canada is the risk of the tree wells.
Right.
But that's a much more manageable risk. The first way to avoid it is to avoid the trees. The second way is, of course, to ski pretty close to a friend.
Right. So you mentioned Revelstoke. Is that one of your favorite? Like, do you drive there often? Like, that's a good haul for you.
Yeah,
right?
It's like I think Revi ticks so many boxes. Right. It's got really steep terrain. It's got really long runs. It's Revi's awesome. And the main reason it's awesome is because it's far from everywhere else. You just don't get.
It's in the middle of nowhere. It's like halfway between Kelowna and Calgary. So it's like
which is basically between nowhere and nowhere. Right.
Exactly. I gotta tell you a story, Louis, because so when I started cat skiing, Revi was our place that we used to go. That used to be a cat skiing operation. And on the last year that we were there, that we were skiing it for the last time because it had been bought by a resort and it was going to be in the midst of turning into the resort that we now know. They had cut the gondola path. And usually we just would take the cat down, and the guide said to us, listen, it's your last time. They cut this path. Do you want to ski this path? You want to ski the gondola cut? And we said, even though it had been 4 or 5 days, we, a bunch of, 30-odd-year-old banker, investment bankers and stuff, we were all there. And we, of course we do, we go, and it ends up being the steepest, and it's narrow, and it's not natural because it's just cut. And we just got chewed up something terrible. And the funny thing about it is, was
the guy pulling your leg? Yeah. Was he setting you up for a fall?
No, so he just said, "You guys want to ski this?" And the funniest thing about it is that one of my good buddies said, he was an investment banker. He says, "What are you going to call this? Kill the banker?" And sure enough,
it's still there.
It's there, and they named it after us.
Well, your claim to fame.
That's right. So it was my buddy Chris named it.
You'll have left a big mark on this world. That's
not me. It wasn't me. It was Chris. He comes up with the great lines. So listen, Louis, why don't you tell people where they can find you or learn more about your firm and your product?
Yeah, absolutely. Thanks. Well, again, thanks for having me. It's always great to catch up. Huge fan of your work. We have at GavCal, we do many different things. The best way is, of course, to go to our website. So our main, so it's gavcal.com, GAVKAL. Most of the research we publish is for institutional investors. We have started a sort of more sort of high net worth retail investor newsletter that's run out of our Paris office. That's GavCal Intelligence Software, so GIS. Yeah, we also have a private wealth business out of Bellevue called Evergreen GavCal. Any one of these websites, you'll find lots of information on us.
Well, that's terrific. Thank you so much for coming, Louis. I really look forward to it.
Thank you.
And
great interview.
I look forward to getting you back in the fall, and we can hear about your beautiful time, mountain biking through Whistler and all the great things that you're doing there.
All right. We have the pleasure of being joined by Brent Kochuba over at Spock Gamma. Brent, how are you?
I'm doing really well. Thank you guys for having me on. Love to talk to you again.
So, Brent, it's Kev here. A lot to talk about since we were last on. It seems like it just flies by, right? Like, another quarter goes by.
It really does. It's, 6 or 8 months ago, it was a whole different world, which is a strange thing to say even in COVID times, so the markets have changed so much.
But there's progress in terms of people understanding options and understanding how much the tail is wagging the dog. It continues to evolve.
Yeah, 100%. It's been really just remarkable. I mean, we've been fortunate in that we're in the options business, and so rising tide lifts all boats kind of thing. But the options market's evolved, and like you said, people have really come to appreciate the impact that it's had. It's really remarkable.
So let's dig into the charts you sent us. A great pack, and let's just start with this disarm weaponized gamma. And why don't you walk us through in terms of what you're thinking there and what's happened?
Yeah, so in August it was SoftBank. That's what we were talking about, and we had a long conversation about this idea of weaponized gamma, and at the time we were trying to discuss and figure out, was it SoftBank that figured this gamma leverage play out, and were they exploiting it to kind of jam the markets? And we had thought at the time that there would be big entities out there that could quote unquote weaponize gamma, which is of course forcing market makers to buy stock when a whole bunch of people go out and buy calls. So we thought, would a big hedge fund do this, or would like North Korea or somebody come out and attack the U.S. financial markets by buying options? And it turns out that it was retail, which I never expected, but that's pretty much what happened.
It's fascinating because the Wall Street Bets crew, they really grabbed a hold of it and started to figure out that they could get the market makers by the short and curlies and really squeeze, right? And we've seen some unbelievable moves in terms of what they've done in terms of certain stocks.
Yeah. There's no doubt about that. I mean, I would even, GameStop, obviously everyone knows that story. But if you think about Tesla and how that worked out with Tesla, I mean, that was really kind of the first big squeeze, and really, I feel like that got gamma squeezed into the S&P 500, right? And then it got marked up at this crazy valuation. And I know that, the future of cars is electric and people love Tesla. And so I don't want to have a horde coming after me for saying this, but, that got pumped up to one heck of a valuation and then transferred over to the S&P 500. And, since then it's kind of been floundering. But that was kind of the first real, I felt like, coordinated gamma squeeze.
I agree. I agree completely. It really was. And what's amazing about that was it was so big. You would think that they wouldn't be able to do it on something that big, but yet they seem to actually influence it.
Yeah, I have a conspiracy theory that Elon Musk is long a lot of he's long a lot of options. His compensation is based on options. He understands Black-Scholes. He's made tweets about it. They had convertible bonds that were hedged with options. So I think that there's just a big Wall Street, quote unquote, options position, long options position in there, and retail was just kind of the icing on the cake there in some ways with Tesla, so to speak.
So I hear you. So you really do think it was Wall Street pushing that around as opposed to the Wall Street Bets crew. Okay, so
what's interesting that I'm sorry, I didn't mean to cut you off, but you could see every week, every Friday. No problem. Every Friday, you could see the weekly call options roll in. So there was definitely, and there was a ton of options volume. So there's no doubt about that. The market cap of that stock is so much longer than GameStop. But so you just had this humongous existing kind of quote unquote Wall Street options position with Elon's, compensation based on options and the like. And then retail was just on top. And it would every Friday it would pin whatever the highest gamma strike was, and that happened week after week throughout really the whole, into August, into really the S&P ad. So I think it was kind of just a combination of Wall Street and retail.
Right. So let's talk about the one stock that is on everyone's lips, which was the GameStop. And I thought at this point, we'd be stopped talking about it, but here we are, and we're taping this on Friday, and GameStop is yet going for another run. So why don't you walk us through kind of the evolution of this story and how you see it from your lens as somebody who studies the option markets?
Sure. So we put out a pretty robust report about this for people that really kind of want to, dive deep into the weeds. But essentially what was really interesting about the GameStop gamma squeeze is that, there was a big short cover rally. And with these gamma squeezes, the options position, when it's set up the right way, it's ready for a squeeze. And oftentimes you need a catalyst, right? It's not necessarily enough. Like, it's not always just enough just to have a lot of calls positioned the right way. So, it was retail wanting to buy, it was the short covering, aspect of it that really helped it pop. But what's kind of helped hold it up is put sales. In that implied volatility has been so high that there's been a lot of, and I think this is a quote unquote Wall Street trade of selling puts, right? Because the volatility is so high. You don't want to short calls, at least certainly not naked, because the stock, there's really no ceiling for the stock. But put sales has been really high. And what's interesting about that from my perspective is I think that helps put a floor into the stock now. Because if you think about dealers are, they're long puts naturally now, right? If people are selling. So dealers are kind of hedged in a certain unique way. That, also when people are selling puts, dealers are buying stock to offset some of their long put holdings. And so that can help kind of buoy the stock and hold it up in a way. So that's really kind of what's been interesting and really unique about the GameStop saga here, and why we've had round 2 and 3. It's because these put sales have really put a floor in. So in the chart here, you see what we did is we measured what was total hedge delta. Oftentimes people talk about gamma, right? Because gamma is the rate of change of delta. So gamma is what the dealers have to do once the positions are put on. But as you can see in this chart, the deltas in this case match the stock price exactly, and those deltas are all the result of call buying and put sales. So when we net out how people actually traded the positions, we found that people on net were buying calls and selling puts, and that all adds up into a positive delta trade for market makers. So that's what really gets that kind of ball rolling in this case, is all these positive delta trades. And you can see those two, the stock price and the amount of deltas needed to buy, those match exactly.
Now, a couple of things. First of all, you mentioned that a lot of people were selling puts. A good friend of ours of the show, Harris Kupperman, Cuppy, he loves this trade. He's been selling GameStop puts forever. He thinks it's terrific. He looks at the volatility. He says, "Look at all the yield I can pick up there." So that is a trade that many of the Wall Street pros have been doing. But why don't you walk us through, just explain a little bit to people that aren't familiar, why, if people have sold the market makers puts, why that puts a floor on the stock and might dampen any decline that we see?
Yeah, so the put sales all seem to be happening at strikes that go up from, say, 100 up to 200 in strikes. So there's a lot of put sales. There's a lot of now large gamma sort of positions that are spaced out kind of in that area. And so the market makers are going to be naturally now hedged, right? So if someone was to come out and buy a put, a dealer would normally be short a put and need to short stock, right?
Right.
But when the investors or traders are on the other side, they're selling puts. Market makers are now long puts, so they're kind of hedged for downside risk, right? And they would maybe buy some stock now to help hedge out their long put position. So normally what you'd have is you would say, oh, GameStop just went up to 800. I think the stock is not valued at that much. I'm going to buy puts because I think it's going to crash, right? But in this case, so obviously when people are buying puts, dealers have to short stock, and that is what kind of helps pressure the name down. But in this case now, when the bulk of investors are selling puts, that's actually, there's no downside risk there now for a market maker, right? Because they're naturally long puts.
Right.
That makes
so,
sense. So they're
and so not only that, they're long gamma down there, whereas in the past, like on the S&P, we almost see the opposite situation. Like as the S&P goes down and the dealers end up being short gamma, they need to sell more as it's going down and buy more as it's going up. And in this case, it's actually the opposite. They've gotten themselves long gamma down below. Now, they must be short gamma up above, though, because all these clients are buying the call options. That number must be huge.
Yeah. So what's interesting is when we have this system that looks at the options position, and it's called the Equity Hub, and what it shows you is where all these positions, in other words, where big put positions are laid out versus big call positions, and that sort of flipping point is around the $300 line right now, meaning it's mostly put gamma that's in control of the name here. We note that 250 is the highest gamma strike today, and 50% of GameStop gamma expires on the close today, which is Friday the 12th. And so if the stock breaks out over 300, that's kind of where the long gamma trade we think starts to kick in. And there's this unbelievable, price that I say it's unbelievable. It's not unbelievable. It's just coming out of my mouth. It sounds funny, but 800 now is the strike that all these guys, the Wall Street Bets crowd, have been buying calls at, and that is now the biggest. That's the biggest delta strike out there right now.
You're kidding. I had no idea. It's the biggest delta. Not only is it the biggest, like in terms of open interest, it has the largest delta, even though the delta's got to be, minuscule.
Minuscule. Yeah. I mean, that's what the system, and that number popped up. So it was 60, and there's a lot of 60 strike options expiring today. And now, the next level up is kind of 800. So, it's like, yes, the gamma is expensive, calls are expensive, and so what everyone's decided to do is like, we'll just buy, the highest strike available, which is the 800 call. And so I hear myself say this thing, and I'm like, that sounds absurd, but it's GameStop, so anything's
Yeah, it's
possible.
crazy. It's the $800 strike just for 1 week out is being priced at a 500 vol. It's $8 for an 800 strike call
and I think
option.
that's cheap. I think it used to be higher. I think it almost traded 20 or something yesterday. It's unbelievable. And you'll see times. I saw a situation where 2 days before expiry, I think maybe it was 3 days, but anyways, it was one of these weeklies, and 3 days before expiry, GameStop's trading 250 or whatever, and the 800 call went up for that week, meaning like 2 or 3 days. That week, it was traded at $5.
It's crazy.
It's just nuts. And so I just wonder, though, do you think that's got to be the Wall Street Bets crew? Don't you think? I just don't see a large hedge fund kind of doing that. What's your opinion, Brent?
I think that there's certainly some, funds out there that have, volatility strategies out there that they may traffic in that situation. I think, even options overriding is pretty interesting in this case because that vol is so expensive, and GameStop has kind of arguably a floor in there, some of these put sales. But yeah, for a retail to go out, I mean, the average retail account, who can spend, $12,000, $13,000, $14,000 for a call that expires in 2 days? I mean, that just seems kind of wild.
It is nuts. Okay, so why don't we go to the next chart here, and you walk us through what happened with GameStop kind of in the first iteration when it went bananas and went up to $500 when we all got Elon Musk, right? Like when we got GameStop.
Yeah, right. And the GameStop story's been told, and we are going somewhere I think kind of interesting with this for those who are. Did you guys switch slides there? I can't.
No, Patrick is falling down.
Sorry.
I was hoping.
Oh, I'm sorry. Okay.
No, it's okay. I was waiting for him. I was
up.
about to text him and say, "Wake up, buddy." He's gone to sleep.
I was just checking out this options chain chart. Anyway, go ahead. Well, go on, guys.
Yes, mesmerizing. It's are you looking at the Robinhood interface over there?
No.
It's meant to draw you in, I think. Anyways, sorry, bad
No
joke.
worries.
Anyways,
okay, so here we are. We have the GameStop.
You guys were talking about the cost of. Yeah, you guys were talking about the cost of call options, and so we had that measured here with the first spike. And you can see in this chart here that this is the percent of an at-the-money option in GameStop. So on the close of 125, a at-the-money call or put was roughly $25 to $30, and that was on the monthly expiration. So this is again late January, the late February call was say $27, right? And then on 129, in the sort of the depths of the big spike, that same option went to about 30% of the cost of an at-the-money. It was about 30% of the price of the at-the-money where the stock was, right? So
right.
The call went to $163. So the stock was at 300. The at-the-money option cost about 30%, whereas it was only about say 10%, 3 or 4 days before. So not only is the cost going exponentially higher just on a percentage basis, you got to remember that the stock had tripled at that point, right, or even a little bit more than that. So retail is not, I don't think, buying those calls at that point. I mean, that's just unbelievably expensive.
Okay, and so the next slide here is how to disarm the weaponized gamma. And so why don't you walk us through what happened as, we saw these retail and other hedge funds using this against the market makers. And obviously the market makers aren't going to sit there and do that all day. So what happened?
Yeah, so obviously everyone remembers the late January and, was Robinhood in trouble and what about Citadel? What was going on with all of that? And we think, that squeeze happened and it kept happening, right? There were several levels to it or several layers to it because the market makers just couldn't get in front of it. Usually you raise the cost of options up and people say these calls are too expensive. I'm not going to buy these things anymore, right? And the fuel's kind of removed from the tank. But in the GameStop situation, it just kept squeezing higher. There was 2 or 3 rounds of short covering. There was Elon Musk tweeting about it and, Dave Portnoy getting involved and all these guys that caused multiple squeezes. And so usually you could just sort of raise the price of options a little bit and dealers could control their inventory and everything would kind of subside and calm down, right? Calm down. Vol go from expensive to, back to, a medium price, right? But that didn't happen with GameStop. So the way now that we've seen options trade is that the price of options and the implied vol goes through the roof immediately, right? And we've seen it happen with Tilray. When that started, it doubled, for a day, and then the next day it crashed. And then Rocket was sort of, the most recent one where the implied volatility just goes through the roof just immediately. There's no more playing around. The options market makers just raise the cost of options.
Okay, so let's just, Brent, I'm going to jump in here. Let's just take that real slow so that people understand what's going on. We get a situation where a stock gets hot, it starts to take off. And whereas before market makers might have raised vol, let's say the vol is trading at 70, they might have taken it to 80 or 90. Now all of a sudden, with GameStop still in their kind of the last time they got picked off and they got in trouble in the back of their mind, instead of just putting it to 90, they're immediately cranking it to 150 or something. I don't know what the numbers are, but there's something like that.
3, 4, 500.
Yeah.
3, 4, 500.
Okay.
Boy, I know. It's 500 vol on the GameStop right now.
Right, but
that's what I'm saying. It's like we're not even playing around anymore, right? We're not
right,
gonna,
but they're doing this.
We're
We're seeing this in more than just GameStop now. Is the point that I think Brent's making? He's saying this behavior of market makers to back away and to raise vols very quickly is, I guess, what you could say is the result of what's happened with GameStop. Have I got it right?
100%. And remember, it wasn't just GameStop at the time, right? There was AMC and Build-A-Bear Workshop. All these names were getting this call squeeze at the same time. So, what you see now, I mean, Rocket Mortgage was a perfect example of this. It went from 25 to 40, in one day, right? And then immediately, vols just go, 3, 4, 500. They get priced at this unbelievable level. And what does that do? That incents people to say, well, now the calls are so expensive, I might sell calls now, right? And that induces call selling. And so when calls get sold to dealers, that gives dealers a natural long gamma position, right, at prices that are higher. Because if you think about what the bottom line is that you can't hedge convexity by buying or selling deltas, right? If you're just going to use stock to hedge yourself as a market maker, you're exposed to convexity, meaning when price goes up 3, 4, 500% like GameStop was doing, you can't buy enough stock to keep up, right? You have to be long options at some point to hedge out tail risk is what the point is.
Right. So you mentioned Rocket. Sorry, go ahead. Finish your thought, Brent. I'm sorry.
No, I was going to say, so when people come in and sell options, right, because vol gets so high, that naturally helps the dealers get long convexity and hedge their tail risk, hedge their right tail.
Right. Okay. So now, listen, you have another chart here for the GME, the squash, the gamma squeeze. Do you want to do that, or do you want to go on to and show the Rocket squeeze setup? Because you mentioned Rocket already, and
Sure, we can jump to the second one. I mean, this chart just shows that the next time that GameStop jumped, right, GameStop went down to about $50 a share, and then when it spiked up over 100, 120, 130. The cost of options immediately spiked much higher than it was before. So that's kind of what this chart is meant to show, just evidence of what we've been talking about.
Okay, so let's go on to the Rocket, which is the RKT, right? And this was one, I believe you highlighted this in your service, did you not?
Yeah, we did, and we put a YouTube video out on it as well. And we had talked sort of earlier at the top of this with where dealers may shift from being, in a put, where puts sort of dominate a name, into calls. And the difference being that when you have a lot of puts, you can have dealers kind of short covering, and that can lead to some upside volatility, right, on short covering. But that gamma squeeze peters out when the puts sort of hit their largest sort of at the money, or when the puts sort of, when the gamma drops out, right? But when you have calls charging a gamma squeeze, there's not as much of a limit to it, right? It can keep squeezing higher and higher. So the point is here, we have two zones in this case. When the price is under 25, it was mostly put options that were we call it in control of the name, right? That's where the game was being generated. And when the name flipped over 25, that's where calls kick in, and that's where the gamma squeeze can really control or start to provide the fuel sort of for the liftoff, so to speak. And so what you're getting is, what everyone kind of realizes now is the fuel for the gamma squeeze is a lot of call options and then very concentrated open interest at higher prices. Because when you have concentrated open interest at higher strike prices, that is what keeps the gamma squeeze going, right? Because gamma is highest for options that are at the money. So the closer we get to new zones of open interest, the more the fuel can keep sort of reloading or refueling.
So why don't you talk? I know one of my subscribers actually reached out to me and said, oh, Brent's talking about this RKT, and it was before it had taken off. Why don't you tell people what attracted you to that name? Why did you think that this was something that you should be highlighting as a potential to get squeezed?
Yeah. So the first is big open interest at strikes overhead, because that, as we just mentioned, sort of helps fuel things and keep the fuel going, right? Because again, gamma's highs for at the money. So if the name can say move to 25 to 30 and there's a bunch more calls there, that can help fuel things up to 35 and then up into 40, because that gamma squeeze can keep going because of that fuel. And the second one is a high amount of calls versus puts is important. So the trading in RKT at the time, I think it was 5-1 calls to puts, and it was pretty high volume, relative to the underlying stock volume, pretty high call volume relative to underlying stock volume. So that meant that dealers could be a significant piece of the float, right, of what's trading. And then the second one was the options were relatively very cheap. So it was easy for new players to come in, right? Because when new players come in, that's forcing the delta trade, which is the initial trade that dealers need to do to hedge themselves, which is something I think that a lot of people miss now. When a lot of calls are being bought, dealers got to come in and immediately hedge their deltas, and that can really start the ball rolling up. And so, as you can see in this chart here, the cost of an at-the-money option in RKT was only about 3%, right? So, you're talking on a $22 stock, that's pretty cheap, right? And then what happened was the day after the squeeze, that same option went to be about 8 or 10% of an at-the-money of the at-the-money 10% of the stock price. And then 2 days later, which is unfortunately not shown on this chart, it was up around 25 or 30% of the cost.
It's fascinating how fast it goes. So I got to ask, Brent, you got any other names? You got another rocket there that you could talk about? Anything that's on your radar?
Yeah, well, I honestly, we spent the last couple of days looking at GameStop because that 800 strike is it's unbelievable, and 50% of that gamma. So we view the gamma, generally high gamma expiration, like what's happening in GameStop here. That's a pin area where we think that sort of holds the stock down, and when that gamma expires, that enables the stock to sort of move away from that pin level. And if the stock goes over 300, that's where calls kick back in.
So you're saying that there's a lot of GameStop coming off this week, and then that'll hopefully, if it plays out for the bulls, it'll hopefully then enable it to break out because all those put sellers that have been kind of holding it back as the dealers are able to sell their deltas because they're long gamma, the dealers flip from being long gamma to short gamma, and then it really takes off. So you're looking and saying GameStop, it might not be over. There might be fireworks next week. Is that, have I got it right?
Yeah, because if you think. Yeah, if you think about what's happening in the stock right now, right? If it's a lot of short puts in the 200 to 250 area, 250 kind of being the biggest, that dealers are long stock, right, against their put positions in there, and they're able to start selling off some of that long stock now, as we get closer and closer to the 4 o'clock close, and so that. With GameStop, it's horseshoes and hand grenades, right? Like it's so volatile that you're trying to get closer, but a 7% move in GameStop is kind of nothing, So we pull the pin next week. Who knows what happens?
Well, fair enough. Okay, so GameStop is on your radar.
What is interesting was Cuppy was talking about the straddle out to April, but like right now I was looking at it, but at the money straddle is $220 on GameStop to April. The stock's at 280.
I mean, that's crazy, but I wouldn't. I don't know what price you'd have to say, Brent. Here you can short calls at this price. I mean, it's just, it's like.
It's true. Those 800 scare the bejesus out of me. They're so big.
Yeah.
And you got to be aware that GameStop it moves so crazy. Your regular size, you got to take it and you divide by 10. I couldn't believe what I did one on the first time up. I just played around in it. I turned around. I was doing an interview. I turned around. I was like, I can't believe how much I've lost on just a little, odd lot of, it wasn't an odd lot, but it was an odd lot in terms of what I usually trade. And I was shocked in terms of how much you could lose so quickly. So, yeah, you need to be careful with the GameStop. Okay, let's go to this next chart. Oh, sorry. Go ahead, Brent. Go ahead.
No, I would just say sort of one thing. I think the GameStop situation is pretty unique in that, why is it not coming down? Because I think these put sales, I don't think that the normal names like, we mentioned Tilray and Rocket and all these other ones that they're trying to squeeze are functioning in the same way, so that the disarming weaponized gamma seems to apply to everything except for GameStop is sort of this bizarre exception. So
they've got the dealers short so much bend up above that they just can't get rid of it. Okay, so let's go to the this next chart, which is when YOLO goes YOLO. Oh no, did I say that right?
YOLO, no. So we talked about, what all this call buying is doing is call buying is just leverage, right? Because you could spend a couple $100 on a call, and that makes a market maker spend several $1,000s buying stock. And there's record call options, as everyone knows right now. And there's also record put selling. I mean, people are not shy about not wanting to. They don't. Not only do they not want to hedge, they don't want to short stocks anymore, and they want to use an exceeding amount of margin, which is what we're looking at here. And this is not simply this is margin sort of in excess of how much the market has gone up. A lot of people point out when margin debt goes up, if it goes up in sync with stock prices, they say, well, people's portfolios are growing in size, right? Because stocks are going up, margin's naturally going to go up. But the margin rate is increasing in excess of how much stocks are rising. So there's little shorting, and there's a lot of margin debt is what we're showing here. And that is a sign to us of leverage and sort of, really excess speculation.
I'm going to jump in here, Brent, because I see a lot of people. You're absolutely right. They use the margin. They use the total margin debt amount, like the actual notional amount. And with the S&P at new highs, obviously, even if it just stayed as a percentage the same, you would see that figure going up and up and up. But this number that we're looking at is actually as a percent of what market cap or market. I don't even know what they're using, but it's growth.
Yeah, they have a real growth.
Okay.
Yeah. So they do some adjustment here to account for just what you said. How do you look at the real growth of the margin, versus sort of, so they extrapolate sort of what the market has done and show the excess over that.
Right. So now let's go to this next chart, which is massive call options equals more leverage. What are we showing here?
Yeah, so this is data from the OCC, and the OCC shows us whether people are buying or selling options, right? And they show you whether they're bought to open or bought to close, or sold to open, sold to close, et cetera. So you can see it broken down by equities, index, and ETFs. We show this. This is updated weekly. This is shown on our site. But what you can see here is that equity calls have outpaced put buying in spades. And this is not just a story of the small retail. This is across all metrics. So the story of retail buying calls is known, but everyone's buying calls, right? Hedge funds and the like. And there's little interest in having any kind of put activity, or there's no interest in buying puts at all. So no one seems to be prepared for any sort of downside move, which you can't say is necessarily wrong. But what you can say is when you have excessive leverage and a lot of call buying, that just invites a lot of volatility to the system. And so, like last week, we had these unbelievable gap downs where the market goes down, 150 handles in really just a few hours, right? That's kind of replaced what we'd see as like a normal sell-off. It's either everything is just much more violent in terms of how quickly it moves now.
And you think that's a function of the fact that the clients have gotten the dealer short all this gamma up here, and especially to the
it's the leverage long position, right? Everyone's leverage long, and so there's when these call options start to lose, when they start to decay and volatility spikes a little bit, that can lead to just a big unwind of long stock hedges, from a dealer perspective. And then there's also be a lot of short-term puts that come in late, right? Because when you start to get worried that the market's going to drop, you suddenly come in and buy puts to hedge yourself. That means dealers have to short immediately to hedge their position. So what you see is like a spike in weekly options, weekly put options come into the market. And that dealers will scramble to short stock to hedge themselves there. But then that, just like this past week, there was huge put positions in the NASDAQ and QQQ. That earlier this week, we saw that 30% of total gamma in Qs was set to roll off. And so much put decay happened that by Friday, by today, that position was only 2%. So in other words, everyone ran into tech puts last week. That was the trade to do, right? And then the scare goes away and no one wants to hedge anymore. So it's like the hedging is reactive as opposed to, getting in front of a move, so to speak, or
it's fascinating. It's like everyone's just running around chasing the last little bit. Okay, so what's this next chart here? Market sees puts as a yield enhancement.
Yeah. So we noted what you can see here is we take the total amount of puts being bought to open, and we subtract from that the number of puts being sold to open. And what you can see in this chart is that going back to 2018, more puts are being sold to open now than bought to open. And this is sort of the most negative, so to speak, this metric has been, meaning we see more puts being sold to open, and this is in equities, than bought to open in an amount that's never been seen before. And so that means now that dealers are long puts and the investors are short puts. So they're, by and large, people are essentially long risk reversals, right? They're short puts and they're long calls, and that's basically how the market's positioned, which is just more evidence of this kind of leveraged long, no need to hedge,
But the ironic thing
Fed
about that,
tailwind or stimulus tailwind, or
right? But the
whatever you want to call
ironic
it.
thing about that, Brent, is that if the dealers are long puts and short calls, it means that whereas before we used to worry about stocks accelerating to the downside because of the negative gamma kicking in, we now have the exact opposite. We have bids from the dealers down below as they're covering their puts and their long gamma,
Yeah,
and then we have them
yeah,
chasing
and
on the upside.
yeah, that's that's a really good point, and I don't think that's incorrect at all. The question is at what point do the margin calls kick in, right? At what point do people say, I'm short,
Yeah.
whatever Apple puts stocks down 5%, I have to cover? Because if you can force a cover, that's where like a really big move happens lower, right? Because you're squeezed out of your short put position. That means that you got to buy that back in, which immediately would flip dealer positions.
So can I just
yeah.
Patrick, before you jump in, I have one comment about that. So your argument is that yes, the short run, the dealers won't be there chasing every tick. Like they'll be like if they were short puts, they'd be chasing every tick on the way down. But your argument is that because the actual clients are short the puts, we could hit a point where they reach their puke point and they have to unwind everything almost. So it's almost like instead of having a whole bunch of negative gamma, in a little bit we'll experience it all in a big whoosh. Is that kind of the argument of what you think people should be watching out for?
Yeah, it goes from being a gamma trade, which is dealers hedging, as you said, they won't need to hedge because they have some equity put positions, to being a delta trade, which is when all of a sudden, everyone who's short a put has to go, like this one's the real one. And not only would they buy back their short puts, right, which means dealers immediately have to adjust their hedge to be shorter to the market. If investors actually said, hey, not only do I want to cover my short put, I actually want to buy some puts to hedge myself because the market could go lower, then dealers would essentially have to do 2x their short, right?
Right.
Because they got to get flat first, and then they'll have to buy more puts. So it's a bend don't break thing. But what you can just see is the amount of volatility. The way that things are moving is really quite wild. And what is the catalyst to make things break? I mean, your guess is as good as mine. But the amount of leverage that is there, that is sitting there waiting, is in my eyes, quite high.
So Brent, what I see here is obviously you're highlighting the fragility or the instability that could be like a catalyst that creates some sort of potential even liquidity event. But obviously we've been in this circumstance for the last 3 months, right? Like it basically
No doubt.
January through now. I mean, really, I guess the $60,000 question or $64,000 question is like, what is it that's going to potentially be the catalyst that could create something like this? Do you see something in that's catching your attention, or some turn point, or something in the future that is that you're thinking about that could be where some of this gets stress tested?
Yeah, I mean, I'm not going to pretend, to be able to talk, about rates and the credit market, but that's where I would sort of be watching for signs of stress, and the amount of movement in treasuries over the last several weeks has been pretty amazing. And so that's where we would say, okay, that if something really starts to break down there, then we would look for more equity vol. But that so far it's just been these, again, very violent moves where we'll drop 150 or 200 handles like it's nothing, and then there seems to be a bid that comes in a little bit lower, and maybe that's because people know stimulus is coming and the like. But it's clear that it's clear so far that there's a lot more realized volatility. There still seems to be a bid in the market, and what it is that makes people want to change their mind is it's a great question. I don't have a great answer for that. But I do understand that when downside shows, you got to respect that, right? Because you don't know when it's break, not bend, so to speak.
Brent, the answer for Patrick whenever he's asked you if the market's going to crash, you always tell him it's because the U.S. dollar is going to go up.
Ass. You're an ass. Anyway.
I know. I'm sorry.
But true. But it stings because it's true.
Okay.
Yeah.
So can we go to the next chart actually here? Because you mentioned realized volatility going up, and I love this because I think a lot of people always assume that a stock market, bull market, has to be associated with a declining VIX or a declining realized volatility. And we haven't actually experienced this. And it's actually been more like the 98, 99 experience where volatility actually rose as the stock market was rising. Patrick, you want to click to the next slide here, and then let's let Brent talk about this.
Yeah. So what we show here is is basically realized volatility, and you can see what the realized volatility is on a few different time frames. So here I think it's 5-day, 20-day, and 60-day volatility after the COVID crash, particularly after really September and into Q4, has just been expanding. Really on every sort of time frame that we just mentioned, and that is in a time when the market is just trending higher. Right, the market has had a pretty linear move higher. Really since the COVID crash, and it hasn't stopped. What is interesting now, though, is that if you look at the fact that this realized vol is expanding and the VIX has not gone below 20, since the COVID crash. I think 20 is basically the low. And so we're getting much more movement every day, right? Leverage is high, but the market continues to go, up, as you guys mentioned. So, VIX up, market up is something that we're not really used to. It has happened in the past, as you mentioned, but that's certainly an environment we have now, and that's a function of not so much the short vol and selling vol pushing the market higher as much as people getting long gamma to push the market higher.
Does it make you nervous to see those two going up together?
I wouldn't say that it makes me nervous, because things are moving up so rapidly, and you're able to sort of map out the movements, right? From our perspective, we just monitor the options market, and the market has been respecting options levels, meaning, we're still, our models are still working, which is great. But what sort of worries me is this sort of idea that, buy the dip, right? And that's the mantra, and that's what always works. And if you think back to August, we had a 10% drawdown in 2 or 3 days. And that really, that caught a lot of people, I think, off guard, which is surprising. But I think, now if we're positioned with all this leverage and we do get just a natural correction, correcting just 2 or 3% doesn't seem like it's a possibility, right? It's got to, like, a normal sell-off is now 2%, and a correction is going to be like a 20% kind of thing. Right. You know what I mean? With all that realized volatility, as this chart you're looking at here, sorry to cut you off again, we really haven't gone anywhere, which is kind of interesting. It's been a lot of movement inside of this range, which is really kind of a 200 handle range, which is, it's a big range. But I thought I was going to have to update this chart yesterday. We're testing 3950, and then, markets gave it kind of right back today and are back to 3900. So a lot of volatility, but if you zoom out a little bit, we're not going anywhere.
I think there's a lot of rotation going within the market, so a lot of the index is sitting there.
So
go ahead,
Patrick.
Patrick.
Brent, what I was just going to ask. So we're obviously going into the quad next week. Is, from what you're seeing there, is that gamma pin really in play again with the S&P at these levels? And what level are you looking for the pins?
Sure. So the biggest strike today at the moment is 3,900. And there's a lot of spiders at 395. Spiders has been a much larger market in terms of gamma position than the SPX. That's kind of a function, I think, a lot of retail being, trading more actively. And then 4,000 is kind of like where the biggest call area is right now. 4,000 is a big round number, which people like. And so we think kind of the market's going to more or less be within a stone's throw of 3,950 into next Friday. 30% of S&P gamma is what we measure right now expires next Friday, so that's a pretty big amount tied to that Friday expiration.
So it's Kev here. Do we expect to see that kind of expiry pull where it just grinds higher on expiry week? Is there any reason to think that it'll be any different this time?
No, we don't see any reason for that. Generally, the week going into OPEX has the lowest amount of volatility in the markets. And so we're looking for is kind of the market to condense and consolidate, in the 39.25 to 39.50 area, so basically where the market is right now. But also note that all that put gamma that was charged in the Qs and Nasdaq last week, that's all kind of declined and melted away, so to speak. So really, we are looking for just a quiet week next week, and then sort of an unpinning, so to speak, the last week of March.
One of the things that I noticed on your service was that although even though the market had rallied, and typically the dealers end up being long gamma as the market rallies because the call options that the clients have sold to fund their put purchases, at least on the index level, make them long gamma. One of the things that I did notice was that even though they were long, the dealers long S&P gamma, they were short QQQ gamma, which was very interesting. Do you have any insights of why that might have happened, or did you notice any difference in terms of the way that it traded because of that?
Yeah, it's that's been a fascinating aspect because it's part of the rotation. I think is a big reason there that you mentioned before. I mean, you could see several days where IWM, for instance, would be up quite a bit and Nasdaq would be down, and it's also it's been curious because tech is such a big weighting of the S&P, right? So Nasdaq, I think the volatility in Nasdaq really kind of infected, so to speak, the S&P with all that. I mean, it was a pretty substantial, short gamma position to the downside in Qs last week, and so I think that really helped pull down the S&P quite a bit just because of the overlap in some of those tech names, Apple, Amazon, and Tesla's, Tesla's the same. So. You can't sort of look at everything in isolation a lot of times. Right. And right where the Nasdaq kind of stopped out around 300, it was where, those larger put positions were, and those started to decay quite rapidly. And I think that's kind of why the market bounced back up into the 39.50, so violently. And now you just have really big S&P gamma, which I think will kind of hold things together. Right. But you're right that, the rotation on top of just weakness is, really exacerbated things.
So Brent, can I ask a question? How long has Spot Gamma been going now? Is this how long ago did you start?
We started officially in January of last year, so we've been going about a year and a half. The models are kind of launched a little bit before that, but
so I'm curious. You're now a year and a half into your great product, your experiments, your life-changing thing here. What's been the biggest surprise?
I think what really caught us off guard was the growth in really just since August, or into August, the amount of options that people were buying. I mean, we've been aware of the S&P trade and the way that the market would hold to those big gamma levels. That's something we've been studying for 10, 12, 15 years. I mean, it's really been a lifelong exercise, and to see all that start to control the way that the market at large is moving, individual stocks and the like. I mean, it's hard not to be really, shocked by that. And the level of sophistication of retail traders now is really amazing. I mean, you talk to guys that are in college now and they understand all this, and, they're suggesting different ways to model volatility, with machine learning and the like. And it's the way that things are evolving is kind of the most shocking part, I would say.
Well, that's great. So why don't you tell people about your service, where they can find it, and kind of give them the whole spiel?
Yeah, thanks, guys. So spotgamma.com is where you can sign up for a free trial. We provide a service called Equity Hub, where you can model equities up to 3,500 different stocks and ETFs if you want to look at your own positions. Or we send out a twice daily note before the open and after the close, which summarizes what's happening in the indices. So SPX and QQQ are where we focus a lot of that energy.
So make sure you guys go check it out if you're at all interested in trading in it. And it's increasingly becoming a kind of a must-have thing in terms of understanding how these options are moving markets. In the old days, it didn't seem to matter. And Brent, one of the things that I laughed is when I first started on my desk, in the 1990s, nobody cared about index arb. They didn't care that there was nobody ever worried about program trading or something. And while I was there, all of a sudden, program trading got bigger, and all of a sudden, all the regular traders were interested. Are we near programs yet? Are we near programs? What's going on rebalances? And I feel like your kind of way of thinking about options and understanding and getting people to understand it is the exact same. And you were at the forefront of it. So I highly recommend everyone go check out spotgamma.com.
Thank you very much. I really appreciate that, and I always enjoy talking to you guys.
Thanks a lot, Brent,
for coming on. We'll hopefully see you next quarter.
Okay, sounds great.
Okay, it's time for Talking Charts. Patrick is just full of beans today. Let's go, buddy.
All right. So let's talk first of all about top three things, and let's circle back and talk about what were our top three things to watch last week. So number 3, we were talking about the U.S. dollar, whether it was a breakout or a fake out, and the jury's still out. My spidey senses are tingling for the bull side of this dollar. So not consensus, but a little bit of a pullback this week. But so long as the bulls defend the line here, I think that they might have enough juice in the tank to take this 93, 94 on the upside. I'm not calling for a new bull market. Just think it might go a little bit higher here. What's your thinking?
I don't know. It's shocked that you're bullish, though.
Yeah,
really surprised me.
Yeah, you didn't see that one coming from a mile away.
Didn't see it.
So the number 2, we were talking about the inflation numbers, and what do you have to say?
Well, I guess they did disappoint expectations.
They were lower.
Yeah.
The Kevin Muir inflation boogeyman is nowhere to be
Still
found.
not coming. Still not coming. Having said that, the markets are all pricing it in. So the question is, if it doesn't show up eventually, they're definitely going to have to reprice some things. I still think it's coming. PPI was a little hotter than CPI.
Just like the U.S. dollar is going to rally too, right?
That's right. One of us is going to be right, goddammit. Okay, what do we got
Right.
for number 1?
Number 1, we were talking that crude. And really, crude spent the week kind of backfilling that breakout. But so far, it has not done anything wrong. Remember we drew those the slopes, the steepness of the different slopes. The thing is that this is still a very steep slope, and the little pullback was nothing but a little 50% retracement of the advance. I mean, at this stage, the bulls might be able to still pull off one more impulse. Maybe we'll see 70 plus this week. You know what? The bulls haven't dropped the ball yet. Anyway, I don't call this a sell-off just yet. We'll see. What's your thinking? You think there's a little more room to go?
I got nothing to add on crude. Why don't we go to top 3 things for next week?
Yeah. All right. So here we go. First thing. Well, we had Brent talking. OPEX option expiration is coming up on Friday. It's a quad. It's a big one.
It's quad witching.
Yeah, it's quad witching.
People always underestimate, I think, how important that is for the market and the market structure, especially as options become bigger.
Yeah, you made me read like a freaking 30-page like full essay that you wrote about it on in your letter.
I didn't make you read it. You can choose.
I often
choose
choose
not
not
to.
to.
I was going to talk about something.
Yeah,
that was
like
in
so.
it,
I was like, let me just kind of read through this, and then I'm reading, and then I'm reading, and then I'm reading some more, and I'm like, this. And I look at the size of the scrolling wheel on the side, and I go, holy shit, this is long. Like anyway, but
our buddy Morris sent me a note in like the comments. He said something like, "We got to get you either a hobby or a mistress." I told them I couldn't afford the latter.
Anyway, so like Brent was talking about that we could gravitate up into the 39 to 4,000 levels on the S&P. I mean, there's a lot of things, but typically volatility compresses going into this, and so it'll be really interesting whether we kind of crawl higher into that pocket and close there into Friday. I mean, we'll obviously next week be talking about what kind of volatility we'll see on the other side, but really these weeks tend to be quiet unless there's a big surprise. What's your thinking?
I think it's just going to grind higher, frustrate everyone, and we're going to wake up and it's going to be a typical option expiration week where we've ground higher and we end up hitting the highs on Friday morning and then roll over from there.
It usually needs a big catalyst. And you know what? And that really comes to our second and first topics. Let's talk about this. First of all, let's talk a little bit about this rotation into real economy stocks. I mean, the one that we talked about today a little bit was earlier was that Boeing breakout, right?
Yeah.
But
it's a great chart. It's interesting. Not a lot of people are talking about it. Yet look at this thing; it's flying.
Oh, the last few days, just a monster breakout. But then you take a look at let's say just like things like airlines, they continue to plug away at higher highs. You take some of the
I love the car companies. You can do GM.
Oh, just stop for a second. I don't. All right, but you love them, which means I'm going to have to start shorting them. But anyway,
Bought from you, buddy.
Yeah, so high, but these hotel stocks look like they've been going. Even the cruise lines. I mean, we've talked about Carnival before, but all of them money seems to be floating into these beaten down names that everyone sees the light at the end of the tunnel for this vaccine, and they want to rotate out of some of those. Like when you're rotating out of the FANGs, where are you going to go? I mean, some of these beaten down names, at least some of the money's finding it.
Patrick, I'm proud of you there, buddy. Floating into the money is floating into the Carnival, the cruise stock. I like it.
All right, there you go.
You realized you did that. Okay, what's the number one thing we're watching next week?
Well, obviously the FOMC statement, and so this is the interesting part. If they just, if it's a nothing burger and they just deliver what the market expects, then the OPEX will be pretty normal. But it's interesting that we're going into a period where the gamma is the highest on these positioning, and maybe there could be a little bit of a change in this, something that surprises the market. What's your take? You think it's just going to be?
No,
nothing?
I don't think they're going to surprise. I think
but that's consensus. I think that's so that means no one would be expecting a surprise, right?
Well, I guess by its very definition, a surprise is something people aren't expecting.
which is that the Fed does
with
something.
you that they're not expecting any changes, and there's very little people talking about a change in policy. Having said that, there's still all you bond bulls out there screaming about YCC and all the crap and things like that. I think that we're going to be kind of shocked that the Fed doesn't care about it and isn't worried about rates. And I think they're just going to status quo as it goes, and they're just going to let the curve.
Keep talking your book, Kev. Keep talking your book.
I'm not actually that. I'm not that short bonds right now because it's so crowded. I get nervous. You know me.
So you don't think they're you think they're just going to come on? Well, it makes sense. I don't think that anything is really broken in the markets. I think the Fed will be forced to act when things really get dicey, and I don't think anything is dicey at this moment. Yeah. Maybe the fact that the market the market senses that the Fed isn't nervous could be what drives volatility the following week after the pins are lifted, right? Like I think a lot of the market wants the Fed to be sort of. I
don't even know if you have to read so much into it. It just seems to happen every time after OPEX. You just get the OPEX, you get the quarterly, and then all of a sudden it just picks up the next week. Don't overthink it.
All right. Well, let's talk some charts, bud. So let's start off with the S&P. A perfect double top test of the overhead resistance. I don't want to call it a topping formation because we haven't seen anything reverse, but we are right back at the highs. But what's interesting, and it continues to be the interesting part, is it's the underpinning stocks in the market, those outside of those FANG that drive this. And so the easiest way to tell that is taking the S&P 500 and looking at the equal weighted S&P, and that thing is like running away.
Running like it stole something, baby.
Exactly, right? And so, the consolidation, this thing is now 5 days at fresh 52-week highs and just keeps plugging away.
Meanwhile, all my bond friends are screaming that we have to do YCC because it's the economy is like the bond market's causing a catastrophe.
Yeah. I mean, it's been the
won't
trade.
Bite on that one?
No, I won't. So I will not bite on that one. And so, but since November, the equal weighted S&P has been a huge outperformer over the S&P. Let's actually just do a performance overlay. Yeah, not huge, but let's say off of the November low, it's like 26% versus 17%, almost a 10% outperformance since November.
Yeah.
I'll
keep my mouth shut about the death of indexing and everything like that. But
then just do that then. All right, so... But another fresh high, Russell, the small caps, just continuing thing. But what was interesting to me was the Dow Jones is also joined the party. A lot of FANG stocks are in the Dow Jones, and you would think that the Dow wouldn't be able to do that, but really the Dow is just gone.
Patrick, my grandmother phone, she's going to be very happy that you're talking about the Dow. Like, who the heck talks about the Dow?
Listen, it's It's the classic. We got it exactly. Your grandmother's talking down. But the point I'm making is that where all of the lagging is in that Nasdaq, right? Like the Nasdaq has barely 50% retraced that 10+% crushing that came off of the Feb OPEX. And so what we continue to see is rotation out of a lot of those bubble stocks, and a lot of those that story seems to be really over, and it's finding those real economy stocks and the small caps and the playing that recovery, and that story don't seem to be going away, is it?
No, it is not.
See, now let's talk volatility. We're back down to the lows. And obviously, realized volatility is going to, in the gamma pins, comes down to here. So I think that the vol is just expecting to kind of come in like this in the next week or two. But I don't think we're breaking to a lower low. This should be the lower boundary.
Well, you know what? You should do that for our bet, because I think we're going lower next week, a lot lower.
All right. Well, I'll think about it.
Give me away my hand. I'm
yeah,
throwing
you know
it out
what?
there for you.
No, forget this. We're going there. We're going there. I want to bet you on this one. Okay, so what? Let's talk. Actually, we talked already the dollar. Let's. What I wanted to actually do is to look at some of the different sectors. Actually, let's touch a 10-year yield here. Look at that. Just doesn't want to quit, does it?
It's actually a terrible close in terms of bonds on Friday afternoon.
Yeah.
If you think about it, they go out at their lows, basically.
Yeah.
And
when David Tepper and a bunch of these people were talking about that this was enough, everyone was thinking that was the thing, and no, they just turned around and just kept going, right?
It is shocking. What we're going to need to really put the top in terms of yield, is a great bond king telling us the two closes above a certain level are, ushering.
I don't know any bond
market.
kings. I don't know any bond kings that
two
could do that
closes
for
above
us.
3 1/4, and that's it. That means it's ushering in a new bear market.
So, all right.
I don't know.
Maybe
But obviously we're a long
we'll-
way from 3 1/4, but that's what we need. We need some sort of proclamation.
Yeah. So Kev, let's talk about your silly car company idea. This is first of all the cars index, which is the global auto index, which really has not recovered.
But isn't that got Tesla in it, though? But
yes,
doesn't it have-
it does. Yes,
Yeah,
it
you
does.
got to take that out. That's not. We all know Tesla is not a car company; it's a technology company. So it shouldn't be in there.
But really, and you had the idea, but you shared it before, is like going short Tesla against long a Ford or something. What was your idea? Was it something like that?
I liked Ford, GM, and Volkswagen. Dial that chart,
Against,
baby. VOW. I don't know if you have the German one.
Yeah,
Do you have German?
Yeah.
Okay.
Whoa,
Look
what a
at that
run.
thing. Yeah. Volkswagen was my
Well, what did they
favorite.
come up with some new technology or something? What the hell?
I know, it was dirt cheap, and everyone's waking up to the fact that all these car companies have EV, within it. That even if it gets valued at a fraction of what all these, pure plays
Yeah.
get valued at, these things need to be re-rated higher.
What a run.
Yeah,
What a
telling
run.
you. And
But,
then pull up GM.
Yeah, Ford just keeps
Ford,
running.
looking
General
great.
Motors,
GM,
fresh breakout. Yeah, that does measure out to like $65. It could go a little bit longer, but you know what? I think that this is the next place that's going to get faded. Like this is
I like
ridiculous.
I like it.
You like it?
I like your pessimism. I like it. Bring
Really?
it on.
Because
I'm like the emperor. You know that. I like, let the hate flow through you.
the profit margins on these autos has proven through history to being great. And so after General Motors goes and runs 250% to the upside after a 1-year run, now it's a good value play to start buying it. Whatever. It's gonna be like copper. You're gonna come in the next show and you're like, "No, I sold it." You're gonna like.
It's not true. That is not fair about copper. I lasted a long time.
No, I
not
bet
selling
you.
it.
Oh,
you
you
should
know-
pick something else. Like you should pick something else. Like when I bought Tesla at $5 and then sold it at 10 because I got nervous about the market.
Oh,
and I
my
remember
God.
saying something to the effect that you should really keep this thing because you know what? There's a chance this thing really explodes higher. And then I got nervous about the market.
All
and
right.
completely forgot it.
If next week General Motors is somewhere in the pocket of in the 63 to 65 range because it's possible to get up there. I'll make you a bet from that level. We'll do some kind of like
Yeah, so when it's completely out and extended, you're going to bet me boy, you're a hero. So
I guess in hindsight, when I'm thinking about what I just said, it maybe didn't.
So I'm sympathetic to the idea that these things are extended and they're rich on a traditional valuation metric of auto.
Oh,
And I'll tell you something, Patrick, when I
General
was writing
Motors
my
is
piece-
buying General
when I was
Motors is buying
writing my
Bitcoin,
piece-
right?
Yeah, exactly. When I was writing my piece, I reached out to a lot of smart folks that were helping me out with the short side of Tesla. And, not just Tesla, actually, because I also picked on NIO and the other ones. It wasn't just, it was EVs in general. And a lot of smart folks, and when I was telling them the premise of my trade, every single one of them, and these are people that are in the industry that are, really smart, every single one of them, to the last one of them said, I love your trade on the short side of the things, but I just don't think that the long side, you need to do that side. And I was like, oh, geez, that's probably going to be the side that works. And that's just because that's the way life is. When everyone tells you something's not going to work, it works. So I'm
Yeah, see, you're the natural Costanza in the group, right?
I'm the natural Costanza.
right? I'm a
I'm
whatever
a
you
balding,
think, just do
fat
the
man
opposite.
that lives with my parents in my parents' basement. Do you want to go out on a date? No, honestly, I do think that I agree with you. I understand the argument that they're expensive, no doubt about it. But everything's expensive in this market.
But those profit margins, there's no competition for these car companies. Like they're going to have these rich profit margins. They're going to be paying huge dividends.
I'm sure that you and the really smart people that I spoke to will be right over the long run. I have no doubt about it. No doubt at all.
Yeah.
But I just think that in the meantime, these things are headed higher.
All right. Enough of this. Let's talk biotechs. You think that's a bottom? I'm a buyer.
You know what, Patrick? I have trouble being a seller in almost anything these days. Really, the only thing I
Jesus.
want to keep selling is the fangs. Everything
Okay.
else looks like it wants to head higher.
Yeah.
Like when you think.
Oh,
when you-
why don't you do your little victory lap on KRE? Give me the
I don't
I
wanna
told
do-
you so. Just
No,
say I
I
told
would
you so.
never do that.
You were right,
I
though.
get plenty wrong, and you get plenty wrong too, and we both.
Well, I didn't. I wasn't short KRE.
No,
I just
know,
didn't.
and every now and
I
then
just didn't
actually,
take it.
You know what? The blind squirrel finds an acorn, and I found an acorn right there. That's all that happened.
Yeah.
Man.
That was a good call, rotating into that. But again, after a run like this, I don't know. See, my biggest thing is that if we do end up getting some wobbly market volatility in March, so in late March into April, really these things have run so far so fast. Even at this stage, if KRE just does a pullback to $60, it's almost 20% pullback, and that would just be giving back a Fibonacci retracement of its run this year, right?
I'm not disagreeing. It's scary. There's no doubt about it. But the trouble is, every chart looks like this.
yeah.
tell me
Hence
what you're gonna buy.
why.
So
Well,
tell me what you
biotech.
own.
Well, no, but what's wrong with going along something biotech? It's already pulled back. You're getting in
Yeah, so I
a.
don't disagree with that. I have no problem with that.
Right, a lot of the consumer staple names, look at a Procter and Gamble. This thing's been being killed. Maybe there's
Yeah, but
room
that
for
to
this.
me almost looks like it's in a downtrend.
You know what? A downtrend, but in the end, at some point, if you're playing the side that the stocks are going to go up because of Project Zimbabwe, at some point these things are going to start
listen, I'm not a
jumping.
Project Zimbabwe guy because I think that's over.
Oh,
overdone.
but there's no inflation coming then,
No,
right?
but Zimbabwe implies that it's going to be 1,000% inflation and things like that, so they rush into it. I'll tell you what, there, champ. I'll buy KRE against your Procter and Gamble.
Well, I mean, you all right, but it can't be a 1 weeker. We have to make some sort of a bet. We'd have to.
This summer, we'll come back to this trade in this summer.
Okay, all right. We'll benchmark it. Anyway, that's enough for talking charts. Let's go on.
Patrick, it's time for This Week in Trading History. What do you got planned for us?
Well, I wanted to go back to March 9th of 1924 when J.P. Morgan Company worked out a deal to lend the Bank of France $100 million to help stabilize the franc. So the Bank of France was in the middle of a nationwide panic as the value of the franc was plummeting against the pound and the dollar. On this day in history, the franc's exchange rate to the pound sterling was around 123. JP Morgan would provide a $100 million credit line to the bank in exchange for the bank pledging its gold as collateral, and JP Morgan received 6% interest on the loan. The deal worked, and by March 24th, a few weeks later, the rate of the francs to pound sterling would be around 78. But let's discuss what the years to follow, because it's a good story to kind of put context of what was going on at the time. After enduring a traumatic bout of inflation in the years that followed in 1924 to 1926, France stabilized the franc at an undervalued rate. There was some debate about whether that undervaluation was deliberate or not. But once the franc had been stabilized, foreign exchange markets put upward pressure on the franc as confidence in the value was restored. So the finance minister wanted the franc to appreciate a little bit more before formally establishing the peg to gold, while the Bank of France Governor Moreau wanted to resist the exchange market pressure and keep the franc at the lower rate. So later, France formalized its adoption to the gold standard with the monetary law of June of 1928, which was like 3-4 years later, which officially restored convertibility of the franc in terms of gold at a rate that was previously determined a few years earlier in December 1926. But let's put more context on this, because during World War I, most major countries abandoned the gold standard in order to use that fiat currency to fund the war effort of World War I. As a result, those nations experienced high rates of inflation. The desire to bring inflation under control and restore that monetary stability led most countries to plan on returning back to that gold standard at some point after the war. Under the gold standard, the price levels of goods and services was determined by the supply and demand for gold. Although ending inflation was a key motivation in returning to the gold standard, some leading economists of the day expressed fear that the return to the gold standard would cause deflation. And so they feared that the slowing growth of gold production would make the supply of gold insufficient to keep up with the demand, as almost all countries were seeking to return back to the gold standard all relatively about the same time. Many countries began rejoining almost immediately after Britain, which made the decision in 1925. And so it was a really interesting period. There's a great book, Lords of Finance, that talks about all of this. But it was a really interesting period of monetary history. But you know what? The private commercial banks, JP Morgan himself, lending to the Bank of France, that happened.
I like it. It's got I'd like to see that happen today. Like, I'd like to see Jeff Bezos or somebody give a loan to like Italy or something. You know, that'd be funny.
There you
think?
go. Hell, hey, there's room for some of that. Anyway, that's all I've got, Kev.
Okay, Patrick, it's time for skin in the game, and you got me.
Yeah.
You did. I blew it. I didn't do a good job. I tried to get fancy, and while I was getting fancy, I made a bet, and I did the wrong price. And you recognized it was the wrong price, and you picked me off like a veteran that you are. And remind us of what the bet was.
So, it was a one touch to 57.77 on crude oil. Right down along here, and crude basically went nowhere near it.
Yeah,
not even close.
It's embarrassing. It was a bad trade. I just you just want to take that trade and put it into the dustbin and never think about it again. Well, anyways, I will say good for you. Well done, Patrick. You got me. What did you win, by the way? Another pitcher?
It was a pitcher for our Market Huddle piss up.
That's right.
We're having with all of our listeners.
The funniest thing ever. So we're putting aside some dough, as we do this for the pitchers and everything. And Patrick's, I guess your accountant or your assistant or the lady that works with you, she sent me a note and she said something to the effect that it was for the Market Huddle pub night. I was like, I take it she's not a fan of the piss up.
I don't think she's listens to the show, so I don't think she knows what it's called.
Okay.
All right.
I thought she had listened and decided that that was not appropriate.
That's not appropriate.
That's fine if she.
I think our listeners agree that it should be called the piss up.
For sure. That's like always what when after a big day on the desk, like we'd be we're going for a piss up,
Yeah.
I think it's a British thing. I actually think that that's something the British say more than the Americans. But anyways, listen, let me tell you about this game. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows. A Duke and Duke crisp $1 American bill, or a pint of beer, a burger bet, a pitcher, a case of beer, which is a 2-4, or a bottle of wine with a $100 limit. And then finally, the granddaddy that we've never done, the steak dinner. The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and there will be no netting of positions.
Yeah, we settle in full. Yeah, there's a
At
lot
the
of beer
piss
on
up.
the table.
Oh.
You know what? We should have Lena calculate. She's been keeping track of how many pitchers
a
are
lot.
now. It's a lot.
It's a lot.
That's-
Listen, at this point, I'm just happy to go at and like when I finally we come out of lockdown and we're allowed to do this thing. I don't care what the bill is. Like it's gonna be not high enough considering how much I'm looking forward.
Well, you've been stockpiling because you don't go out. So like you have all this pent up demand for pints.
and not only that, I got some good extra weight to to help with the drinking. I'm gonna be a pro. Okay, what do you
All
got
right.
for me?
All
What are
right.
you thinking about this week?
Well, listen, I actually was going to go to the home builders, but when you went to the VIX, I had to take you back here.
Okay.
We're doing this. Over under 20 next Friday. Boom. Let's do it.
Oh,
Take it.
Okay, done. Under.
All right. I'll take over. Let's
Okay,
do it.
okay. Now
Let's-
listen, are you willing to go big on this one?
You name it. I'm ready to play.
I'm ready for the steak on this one.
Done. Forget it.
Nice.
We haven't had a steak dinner for a long
Nice.
time. I like this. I like
That's a
this.
good one. That's a good one.
Steak dinner.
Okay, I'm excited.
I'm taking Wagyu on you. I'm going to go Wagyu on your ass when you lose this. It's going to be embarrassing for you.
So it has to close there. It's not a one touch. It has to close below that.
No,
Friday-
we're
the
talking
Friday close.
Friday's closing VIX level over
The
under
only-
the
yeah,
20.
I'm still taking it. I'm still taking the steak. The only thing that scares me is the Friday sell off. If I'm in the money, I might hedge it. I might hedge my steak with my trade.
Yeah,
But anyways,
just go in there. Yeah.
yeah.
You know what? We haven't done this for. This is
Good steak.
first
This is a good
steak
one.
dinner since we changed the.
Yeah, that's good.
you
That's
know?
good. Okay, well
like
that's
it.
great.
All right. Anyway, so it's time for no
No
stupid
stupid
questions. Lena, hop on.
Hello.
Hey.
Hello, Lena.
We have
See, look at the homework we have in terms of you counting how many pitchers of beer we have.
you're just piling
to-
it on, piling it on.
I know. He just doesn't.
I
he doesn't even think
better
about it.
get a piece of that steak later.
Yeah,
That's what's happening here.
Sounds like a plan. All right, so let's do this. So, what's the first question here, Lena?
First question. Greetings from Germany. You are doing a great job on the Market Huddle. Thank you and the crew for putting this show together every week. You have a corner for no stupid questions where you help listeners understanding markets a bit better. I have a question on my mind that fits in that category too. It is about options and volatility. Maybe Patrick can answer this since he is the options guy. I would assume that traders and investors are de-risking their portfolios closer to the weekend. If that would be the case, the costs for protection or the implied volatility for equities should rise. But in an average week, the volatility index of the S&P 500 VIX is getting crushed on Fridays. Together with the level of the VIX on average, the front end of the term structure is getting pushed down too. This process reverses on Mondays. What is the market mechanism that causes this anomaly?
Oh, Kev, you do it.
Well, you want to start, Patrick, and then I'll jump in.
Well, really, what it comes down to is that volatility has to account for the weekend, right? I think you used to do this on the desk, so
So when we were market makers, we would actually take Friday at lunch or even maybe before, we would take our book and we would mark it into Saturday. Because there's, if you think about it, there's a certain amount of theta on each day that goes by, and on a weekend you get 2 days where there's no trading. So there's a huge amount of theta that occurs over that weekend. So what you're seeing on the Friday is the market makers putting down the volatility to in anticipation of a weekend of no stock movement. And then it's made even worse because as the market makers move down the volatility, we get that Vanna bid to the market because typically how they're set up is as the volatility goes down, they have to buy more deltas. We've had, Jem talked about that. Jem Carson talked about that. Even Brent Kachuba talked about that in previous times. But that's known as the Vanna. And so with the combination of the weekend theta and the Vanna move, that's what you're experiencing.
There you go. All right, so let's go to the next question.
Hey guys, was trying my hand at the dark arts of technical analysis and drawing some fib levels on gold. Am I doing this right, Patrick? If it's even remotely close to what the actual fib levels are, it looks like we're in an interesting range here. I know Kevin is bullish on gold and Patrick is surprisingly bearish, so there has to be a steak dinner bet in this chart somewhere, right? He's included a chart even here.
Yeah,
Considering bullion is one of my largest positions, I don't know if I'm outright bearish, but I was certainly it was a disappointing downtrend that was very distributive in its price action. So it just means that an uptrend isn't starting, but it doesn't mean it's not a good level. But with that said, that is the right fib measurement, and that is the right level. There's really smart guys like Ole Hansen was talking commodities that was looking at the exact same levels around that 1680 retracement zones. But you did it right. Nothing else to say. Let's do the next one.
Sure. Greetings, Patrick and Kevin. I have been listening to your podcast since you started and have enjoyed it. However, I just experienced my first side effect of your show, which is yield control canker sores. Maybe this means YCC is coming soon. Probably so. Hopefully this condition is not too pervasive amongst your listeners. Otherwise, you will need to provide a remedy on this health issue or risk losing some loyal listeners. Now, I have a serious question to ask either of you about future Fed actions, although this might be up Kevin's alley. But Patrick, please opine on the matter also. Let me first preface my question by saying that we certainly agree that what the Fed has done with QE and purchasing of assets such as junk bonds is extraordinary and has only created other problems, one of which is devaluing the dollar. What do you think about the prospects of the Fed purchasing another extraordinary asset such as gold? Not go all out into gold purchases, but just a little to start. Certainly gold prices would rise on this action. Also, this might keep the dollar from weakening, and since the Fed has gold on its balance sheet, it would strengthen their balance sheet, would it not?
Okay, well, I guess that's mine, eh, Patrick?
Yeah. Go ahead.
Okay. So, yes, the Fed is allowed to buy gold. And the listener is completely correct that this would be something that would help in terms of inflate the economy. I would argue that it's actually probably something that should be given more attention, but is rarely, if ever, discussed amongst the, ivory tower academics. So I don't think that it's going to happen anytime soon, but there is technically nothing stopping them from going out and purchasing gold. Do you have anything to add, Patrick?
Nope.
Gold would rise. Well, I'll say this: certainly gold prices would rise on this action? Of course they would. The other thing to think about is that the Federal Reserve isn't buying gold, but the Bank of Russia is buying gold. I can't remember. There's a whole bunch of Eastern, central banks. The Bank of China is buying gold. So it's not like
the U.S. doesn't have to do it, right? But a lot of the other periphery countries that are trying to diversify away from their dependency on the dollar are going to feel holding a certain amount of gold assets is better than getting a zero yield on a treasury on their books, right? And so that definitely Russia and other places like this buying gold makes sense. But I don't think you're going to see the U.S. do it.
Yeah, the U.S. would probably be the last. And not only that, the U.S. has already got it. I think they would only do it in an extraordinary circumstance when their deflation is really crept in and they need to print against something, and they just don't want to buy any more of their own treasuries or that. So I could see it happening eventually in a extreme scenario. But having said that, I always said that the gold market eventually the central banks will come for it. I still contend that there will be $1,000 up week in gold. I know everyone thinks I'm insane for saying that, but I think that eventually you're going to find like the Bank of China.
Yeah, but you also think General Motors is going higher. So
yeah, so I'm pretty stupid. You're absolutely right. But there's no doubt to me that central banks buying it will be the end game, and that will be the point when they start coming forward that you actually want to sell it to them, because they will be the last and most stupid buyer. Anyways.
All right. Let's do the last question here, Lena.
All right, last question of the week. Hi guys, love the show. I've listened to every single episode all the way to the end of each one. I keep seeing Jim Carson on Twitter saying that he continues to fund real convexity with local vol and play short vega, long gamma on the put side, and that he will be looking to move increasingly to dispersion name calls with long gamma. What do you think he means?
Yeah. So first of all, Kevin, thanks for writing in. This is a great question. I read it and I too was confused. I thought I knew what he meant for the second half, but I was like, oh God, you know what? Jim, he's got Gary and Vanna, and he's got these cast of characters that he creates to describe different things. So it is difficult. So what I did was I reached out and I got the actual answer for Jim. So we'll go ahead. I'm going to read it. So long gamma, short vega on the put side is selling calendars on the downside. Obviously, a great trade for this rally. Obviously, for a genius like him. Fund real convexity with local vol refers to selling at the money index vol to buy downside protection. I like broken calendar put butterflies for little to no premium where I buy the middle strike. Also, the classic sell near at the money index puts to buy call spreads and cheap call units in the VIX. There we go. And then he says, I've also been doing 1x2 put spreads in Tesla, buying 2, when momentum is starting to flag, but skew was still too cheap. This is another such example. The plan was to move more dispersion for gamma, sell index vol, buy names. So what he means is he's selling index volatility and he's buying individual company names. That is a classic trade that used to be done, all over Wall Street, where in general, individual stock volatilities would trade lower than they're realized. Meanwhile, index would trade higher than they're realized. So guys would run this big monster dispersion book, and that was a classic book trade. So I think he's basically saying he's going back to the classic. He says the plan was to move to more dispersion for gamma, sell index, buy vol names. When index gamma, Gary, so that's his Gary, becomes pinned. But we have yet to see that happen. But that is that is something if the index vol ever settles down. So anyways, that's like, I'm doing my best here. Like, Jem, we're getting him back on the show. He's gonna be great.
Yeah, he's next level shit.
Yeah, he is next level shit. And it does take an interpreter. For me, when I read the second part, when he was, fund real convexity with local vol and play short vega, I got that. Or no, sorry. He said when we will be looking to move increasingly to dispersion names with long gamma. I knew what that meant. It was the first part where he says fund real convexity with local vol. I was like, I don't know what he means there. Anyway, so hopefully, Kevin, you can rewind there and listen to it again.
And again.
And then again. And if you're really
and then transcribe it.
And then if you're really stuck, give me a thing and I'll send you the actual text. Anyway, thanks for
all right, Lena, let people know where they can send their questions.
So if you have any questions for Kevin and Patrick, submit your questions to nostupidquestions@markethuddle.com.
Because, Kev, there are no stupid questions.
Just stupid answers.
All right. So, that's it for a show, eh?
That's it. All right. Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. Lena's there every single day, and she gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks: Google Podcast, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch there on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, give us a review on iTunes. You know why. Patrick, where can they find you?
You can find me on Twitter at Patrick Sresna, and you can also find me at bigpicturetrading.com. Kev, where can they find you?
On Twitter, I'm at Kevin Muir, or you can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
That was a good show, right?
It was great.
Oh, it was great.
Louis and Brent. Oh, yeah. That was a jam-packed
meaty
session. I
episode.
like
It was
it.
a jam-packed. It was a media episode. Poor Lena has a lot of editing.
And I finished the beer, so I'm well tipsy.
Oh gosh.
Oh,
Well,
that's
Lena,
the-
you did better than me.
Well, there was at least caffeine in this one, so
Was there?
I don't know. I hope so. If they're putting coffee beans into this thing,
I don't know
then
what kind of beans. I still think it's another kind of beans because this is not good. Listen.
Oh,
I'm
stop
gonna
it!
say
This was delicious.
the can. I'm gonna be the artwork on the can guy because that's really like when this.
You're a seller on the artwork. It's very.
No,
simple.
I like the can. This is
Oh
great
my God.
artwork. You don't
What?
think it's good?
No.
I think it's great. I think
It's
the
too-
color.
Oh, come on.
It's green and orange. It's kind of got like
Old
8-year-old boy
school
colors.
kind of vibe, you know?
Yeah, I
Oh.
like it. I like it. So
Like
Lena, why don't you
it's like
start?
a Gators thing. Like,
I liked it actually. It was surprisingly better than I had expected, to be honest. Because I was like, "Ooh, coffee blonde."
see,
I don't.
she has good
know.
taste, Kev.
But again, to each their own. But
That's what makes
Listen,
market.
I agree with you.
That's what makes a market. That's fine.
This is
That's what
music
makes
to
a
my
market.
ears.
I
go ahead,
would
Lena, give us the
this
score.
A 7.8.
Okay, Patrick,
bad.
how about you?
I'm going to go 8.2. This was a
Oh.
great. You know what? This is a lunchtime
God.
beer. You know, after I've done my entire pot of coffee and I'm having a sandwich and I need something in
Did
the
you talk
afternoon.
about like having a morning
can of
coffee and
beans.
then having this beer, and now you're talking about lunchtime beer? Like,
Well, listen. All I'm saying is it's called can of beans and it's perfect. It's like a nice afternoon pick me upper.
Oh my God, you guys are way too off. You guys are like wrong big figures by many handles.
All right, what are you rating it?
I agree to. That's right. That's what makes a market 4-1, and the only reason it got a 4-1 is it's great can.
yeah, Kevin didn't like
What?
this very much.
No.
You don't even. You've never gone under 5.
Oh, yes, I have.
That's like another wave of
Listen,
territory.
No
They're not
matter
going to
how-
sponsor the show anymore.
I know, but you know what?
They have other beers.
They have other beers. It's just. I feel like I really should make some categories because I don't think I knew I saw coffee and I just like blondes in general I don't like, but then the coffee like it's just a bad
Blondes and
mix.
beer you're talking about, right?
Yeah, blondes and yeah.
I love blondes and beer.
Blondes and beer, is that what you said?
Yeah.
Anyway.
Nothing wrong with a redhead topped in there too. No, I'm just kidding.
Oh, yeah.
Okay.
All right.
Yeah.
Lena, so everyone, we're not going to talk about something because everything's fine with the puppies. Everything's good. No worries, but we're having a little withdrawal
Yeah.
symptoms. And so everything's good. Everyone's going to nice homes, but we're not going to discuss it
Yeah,
anymore.
I think I'm just gonna have like
There
an
you go.
empty nest syndrome sort of thing.
Yeah. I just don't want anyone to be worried about the puppies. The
Yep.
puppies are great. Everything's fine. The mom isn't doing as well.
Oh, the mom dog is
it-
fine. It's just me. I'm just a mess.
No, but yeah, the grandma or whatever you call yourself.
I'm just
I
a
don't know
mess,
what you
but-
call yourself. But so we're going to talk about something else. So Patrick has informed us that he's actually watching
informed.
TV,
Informed.
and that we should ask.
I
him
did-
about
I did
All right,
watch
let's
TV.
see if it's
I
from this
didn't-
year. Shoot.
No, what do you mean it's from this year? I'm going back into archives, right? So I tried 2 new things. First of all, I didn't even know about this show on Showtime, Black Monday. Have you watched it?
No, what is it?
It's a season that's about the October 19th, 1987 market crash, but they made it into a comedy about all of these like outsiders and what caused the crash of 1987, and it's funny as fuck.
He just can't
I had
get
no
away
idea.
from the market. I see.
No, I know.
Oh, it's
like
got
I
that
had.
guy. Is that Ed Cheadle or something? Is that guy's name? Like that guy's
Yeah.
really funny.
Oh no, it's actually funny. Like I only watched 1 episode,
year
but
is
I'm
it
in. I'm in. I had a friend that told me about this, and I don't know what year it is. It's 2 seasons in, so I guess
No, it's 2019.
Oh, okay,
it's
it's
like
recent.
recent.
Yeah.
Recent. Yeah.
so.
Yeah.
But the,
Don Cheadle. Did I say Ed? Anyways,
Yeah,
Don
Cheadle's
Cheadle.
funny.
Yeah. But anyway, the first episode anyway was really funny. Anyway, I liked it. I'm in. But the other thing was, I tried this Archer
The,
TV
the animated series you're talking about? Oh, it's hilarious.
Yeah. Like, you know what? I'm in. Like, you know what? This is
Patrick's like
that's
deciding
11.
TV. Like, oh, a TV show. I can't believe how good TV's gotten in the last 25 years. Patrick, this is a
it's-
cartoon.
But it's good.
Yeah.
It's
Oh my
good.
God.
I liked Archer. I
Oh
finished.
my God! It is like an adult animated sitcom, and it is just
Yeah, it's
the jokes
funny.
in there are
It's-
epic.
Okay, I'm gonna give it a whirl. 11
It's good.
seasons. So if you like it, you got a lot of
Oh.
content there.
Oh, it's good. Like I can't believe it took me this long to discover. Like I bet a bunch of our listeners are like fucking laughing their heads off. Like, what they
Yeah,
didn't know
Archer's
about.
been
No, but
around for quite
it's-
some time, so it's good.
Wow,
Yeah.
I didn't know that.
It's on
Okay,
Netflix.
good. Well, there you go. I'm proud
There
of
you go,
Patrick.
Oh, thank you.
The kids
Thanks,
might
Dad.
Even, the kids
Thanks,
might,
Dad.
The kids might
You're
even
proud
say
of
that's
me.
a good pick.
I don't think the kids are allowed
All
to
right.
watch this one.
What are you guys watching?
I don't know, but I want to go back to this Black Monday thing.
Okay.
I've got this picture where they're near a subway stop and they're wearing pants, and the one guy's wearing pants that are so bad they're not tapered at all, and they're actually big and baggy.
Oh, like those raver
And,
pants?
like, on a suit?
Is that what you're talking about?
No, I don't know. It's on a suit or whatever, but like just like the main guy, like the not Don Cheadle, but the other guy. Anyways, I've seen pictures of my suits, or forget about pictures. I've tried on pants from way back when, and I couldn't believe how bad they were. Lena, I'm telling you, I was like, come on, I wore this.
Oh, yeah.
Like they are so bad. They are it's a
Lies. They
terrible,
don't fit
terrible
you
look.
anymore. What are you talking about?
You know.
Like the men's pants. Like if
You know what? You know that
And
Wonder
they're probably
Woman
it's going to come
movie.
back
Oh,
now,
probably.
Patrick.
You know
It's gonna-
that Wonder Woman. You know that Wonder Woman 1984, whatever they did there. Like they were generous to the 80s.
Yeah.
They were generous. It was much worse. It was much worse than that movie. Like
Yeah, they always kind of
the shit we wore in the 80s should never be allowed to come back.
Well,
Like-
I still think the one thing that shouldn't be allowed to come back is those jeans in the 90s that the
Oh,
kids
the ones that
wore.
you can't see your shoes?
That-
yeah.
Yeah. Those are just like they're like bell bottom, but like it starts
They're
at
like
your
tree
waist.
Over the
It's
top.
almost
right?
like a
Yeah.
dress. Yeah, just so bad. What were they thinking?
They weren't.
I just like that.
Oh.
That's like the worst. That's the worst.
Is there something in this generation that's like that? Is there something right now that I'm just trying to think? Like,
Well, you know the funny thing about this generation is like my wife and I laugh about it all the time. It's literally what we wore when we were in high school.
Yep.
Like I see my kids, I see what they wear.
It's just a little bit of an
Like,
update,
and it's-
but it's basically the same thing.
Yeah, of course. It's never exactly the same.
They're
but
like
there's all
grungy.
sorts of things that are like, and they think that they're discovering things for the first time. Because they're doing, what they're pushing back against is like Lena's generation.
Yeah.
Right?
Yeah,
Because they
the
think that that's like
Yeah.
not cool. And so the next generation has to be like, oh, we're not going to do what this Lena, the millennials did. So we got to pick something else. So they're going back to the.
Yeah, we all think we're all so
You know what's amazing,
original, right?
Patrick? Yeah.
No.
You know what's amazing, Patrick, is that like if you think about it, when we were in the 80s and or like 90s and we were listening to 60s music, and that seemed like so long ago and so crazy and retro. Think about that. That's like them listening to 80s music now.
Yeah.
you just blew my mind. What? That's crazy.
It is crazy, but they always and the funny thing about it is we try to get our kids to watch like old movies, and they're always like, "Oh, the effects are so bad. Like, how do you watch this shit?" They're always like, they're literally like, my son's like, we were like, "Oh, we'll watch Jaws. You guys will be scared," and he's like, "Scared? Look at this thing. That's completely a fake. That's not
It's just a
scary."
joke.
Yeah, exactly.
Oh, I used to get scared watching.
They
Jaws.
they do not fall for it, and. But
But
anyways,
you guys gotta have to watch this TV show. This is a docu-series. I've been meaning to tell you guys about this because I thought this is crazy.
Okay, what is it?
Murder Among the Mormons.
Oh, so I'm trying to get my wife to watch that, and she's because she loves the murder
Yeah,
shows.
it's good. It's good. You have to watch it.
Yeah?
It's good. I think
And so, but it's a documentary,
docuseries.
so it's like
Yeah,
based on a
it's
real
based
story.
on true stories, and it's fascinating. When you watch it, I
Among Mormons?
Yeah.
I would have never.
did you?
No, I
yeah,
would've never heard
I was actually very surprised, but you watch it and you're like, this is a true story. You like I was shocked. So I recommend it. I highly recommend it. And
Lena, did you see that skit the other day on Saturday Night Live that was about a woman that her boyfriend goes out and she decides she's going to watch a murder show?
no, I haven't.
Oh, you got to Google it. It's all about like all these women.
Oh,
and
is this like they're okay to
get a
they
chance,
can't watch
they-
horror movies, but they can watch murder series?
Well, no, just that they get some time alone to unwind, and they choose. They watch murder shows.
I will look it up.
Anyways, it just made me laugh because it made me
I'll
think
have to
about it
watch
when you start telling me another
but,
murder show.
But speaking of murder
Yeah.
shows, I have another show too, another docuseries.
Okay, what's your
It's
second
called
one?
Vanishing at the Cecil Hotel.
Oh, you know what? I saw that and we were gonna do it. Is it good?
It's good because it's about. I remember seeing this incident on the news. Actually, there was like a footage of this young woman in the elevator, and she vanished, and that was like the last footage of her. So I remember that
Yeah.
seeing that on the news, and then when I saw that docu series on Netflix, I watched it. And it was a little bit. It kind of made my hair on the back of my neck kind of stand up a little bit. It was kind of strange and eerie, but it's good. It's interesting for sure. Highly
Okay,
recommend.
well there you go.
And Louder Milk is now available in the U.S. on Amazon Prime, I think.
Oh, everyone,
Oh.
listen. Okay, so for all of our American friends that when I told them they got all pissed off because they couldn't watch it, go watch Louder Milk. Patrick, where are you? Did you finish it?
I'm in the middle of the second season.
Nice. How many are there? 3?
I don't know. I'm only in the middle of the second.
I can't remember.
I-
Anyways, best show on TV. Tell me why I'm wrong. Prove me wrong. I'm like that guy that that.
I don't know.
that-
You know
that
what?
meme with, the guy
I won't lie. I won't lie. When I'm choosing between that and Archer, I am choosing Archer more.
Really?
often.
Well, I'm gonna have to go. I can't make a judgment before I watch Archer. That's a
But
pretty tall.
listen,
that's a pretty
but
tall
both
order,
are
though.
pretty. But they're both pretty awesome. You know what? If I make it past 3 episodes into any series, it's like a fucking miracle, right? Like this is, I have like the shortest attention span on like, when you guys tell me to watch something, oh yeah, that's all right, and then no
Look,
more
squirrel.
after that. What?
Okay, well, listen. Why don't we cut it short because Lena has a lot of
Yeah.
editing tonight.
Yeah.
And I don't know. I didn't watch anything interesting to talk about.
All right, there you go.
Yeah.
Okay. Anyways,
Well,
it
thanks
was,
for
it was,
tuning in,
it was a lot of
everyone.
fun. Yeah.
Yeah, it was a great
thanks,
show,
everyone.
and we'll see everyone next week. Stay safe, and we have some great guests coming up, and we're looking forward to spending some more time with you in the future. Take care.
Have a good weekend.
All right. Take care, everyone.